There's a lot of things that the market is getting wrong right now.
We were mispriced, I think, for the path of Fed policy. And now I think we're getting back to a more realistic level.
Now the market's starting to think the Fed's going to go further than they are communicating right now.
Some of this rally is chasing. It's the FOMO rally.
We are in an every data point matters type of environment now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The pain trade gets more painful over the last 24 hours. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures right now down 1/10% on the S&P. Yesterday, yields pushing higher. And what happened, Tom? The NASDAQ outperformed. The NASDAQ year to date is absolutely flying by 15%.
Just nailed there with FOMO. Guess what? It's FOMO Thursday. That's where we are right now. What I'm going to look at, one statistic just to get the morning started here with claims coming up and all the rest. On the market, you're missing. We had an accommodation yesterday of 0.50 standard deviations. That's a new high on the Bloomberg Financial Conditions Index. And even as we speak at a 0.44, this is an accommodative market going against Chairman Powell.
You're going to love this note from Marko Kolanovic then, to build on that, Tom. Out yesterday with this quote here. There's an old adage, don't fight the Fed. You've all heard that.
Oh, really?
But this behavior is not just fighting the Fed, but also taunting the Fed, with crypto meme stocks and unprofitable companies responding best to Fed communications. This is the problem. It always is. You can nail one call and then get the other call dead wrong. So you can nail the call on the Fed and you can say data's going to be good, Lisa, rates are going to go higher. So what's going to outperform in equities? Tech? I don't think tech's the answer.
Okay, first of all, the point about a stronger economy doesn't edify the reason why meme stocks are outperforming. That is not necessarily a logical conclusion. But to Marko Kolanovic's point, this is something that we heard from Torsten Slok yesterday as well. Does what we're seeing in tech stocks, in meme stocks, actually force the Fed to go further, actually force the hands of all of the no-landing scenarios and get to a different kind of outcome?
There's a real equity story emerging in Europe as well. Record high in France on the CAC 40, record high on a FTSE
I'm glad
in the
you
UK.
bring this up.
We're going to get earnings from Hermes and Air France tomorrow. Hermes so far year to date up 20%. Do you want Air France KLM year to date up close to 35%?
Wow.
Year to date. You've seen some monster gains over in Europe too.
Yeah, I'm looking at Japanese economic statistics. Guess what? Inflation's higher. I mean, that's where we are, and they got some GDP numbers coming out. And I agree, it's not just America that's doing this. And the Europe numbers, I think, are frankly more stunning.
Next stop for this market, jobless claims in a couple of hours' time. Let's whip through the price action for you. Equity futures right now down 0.1%. In the bond market, new highs for the year on a 2-year in yesterday's session. Intraday coming really, really close to 470, then backing away a bit this morning as well. We're down 5 basis points on a 2-year at 458. Maybe you can call that 459. Euro dollar advancing just a little bit, reclaiming a 107 handle. Bramo 107.04 on euro dollar, positive about 0.1%.
Man, the euro dollar has been so stable, I will say, just kind of bouncing around that particular range. And I am curious where we break out to. Today, what we're watching, 8:30 a.m., the big data dump, including PPI, jobless claims, housing starts, and building permits. With respect to PPI, how much do we get an edification of the disinflation in goods? If we get a repudiation of that, if we get a surprise upside print here with respect to inflation for goods, do we get some sort of more significant response in markets? And I guess the answer is, which market? Today, we get a host of speak from European central bankers, including the Bank of England chief economist Hugh Pill, Deutsche Bundesbank President Joachim Nagel, and ECB executive board member Philip Lane. To me, this is really the big question. We see, yes, 2-year yields in the U.S. reaching new multi-year highs, but also over in Germany at a time when we heard yesterday ECB chair coming out and saying, Christine Lagarde saying, 50 basis points still very much on the table for the next meeting, and then they'll see after that. So how much they really double down in that manner. And today, the Fed speak includes Cleveland Fed President Loretta Mester, St. Louis Fed President Jim Bullard, and Fed Governor Lisa Cook. How do they respond to the meme stock, to the tech stocks that are rallying? And I'm not expecting them to come out and give you some sort of option on Bed Bath & Beyond's, but I am curious, John, whether they feel taunted, whether they feel like they've got to push back a little more aggressively on financial condition easing than perhaps we heard from Fed Chair Jay Powell.
It's a difficult market to call, that's for sure. Lisa, thank you. Joining us now to discuss, Russ Kostrick, Global Allocation Fund Portfolio Manager over at BlackRock. Russ, let's start there. The closing low on the 2-year, I think, was January 18th. Just north of 4%, 4.08%. We're higher by about 50 basis points since then. Over that same period, we've seen the NASDAQ absolutely rip, Russ. What gives?
Good morning, Jonathan. It's interesting because when you think about last year was very driven by rate beta. In other words, the sensitivity of the stock market, particularly growth stocks, and even more than that, the early growth names, to both nominal and real rates. And exactly as you point out, we've seen this move higher in rates and the NASDAQ is ripping. My guess is the simple answer is you've had a reversal from really extreme positioning at the end of 22, and that hasn't clearly ended yet. You had massive tax loss selling at the end of 22. You had massive shorts in a lot of these names. As people have come into the new year, that pressure is abated. I don't think that can carry us throughout the year. I don't think meme stocks and early growth are what leads us in 23. But a lot of this has been a reversal of that very tough year you had, particularly at the end in 22.
Russ, beneath the radar, really not even reported in the Western press, was Japan GDP. The nominal GDP of Japan was sub 2%. Is that the great miscall in the markets now, is we don't understand the impact of an elevated and more persistent nominal GDP in the United States, and as John Ferro mentions as well, in war-torn Europe?
Well, I think this is actually a really important point, Tom. You ask, why is the stock market up? And let's leave the meme stocks out for a moment.
Yeah, please.
The glass is half full argument is exactly what you're alluding to. So you had a view 3-4 months ago about a hard landing. Let's call that, the economy contracting 1 or 2%. And now you've got a better and better likelihood of either a soft or a no landing. So if you have 1% growth in 23, which doesn't seem outlandish right now, and 3 or 4% inflation on top of that, that's 4 or 5% nominal GDP. That is a much bigger tailwind for earnings growth in the U.S., probably to some extent in Europe as well, that investors were expecting 6 months ago. And that's one of the reasons, probably the right reason, why the stock market has been as resilient as it's been.
Lisa, this is really important. Nominal GDP across a pandemic from a high of 17%. That's a boom economy, fear of missing out. Down to 10%, down to 9%, and nominal GDP in America 7.3% versus under 2% in Japan, and we're wondering why stocks are going up? Well, there's a spirit out there in the U.S. It's irrefutable.
And this really goes to the question, Russ, and I'd love your take on this. How much of the rally that we've seen, the sort of rethink of what we saw last year, is justified based on better than expected economic data?
Well, I think it is justified. Again, I think the stocks can have a decent year. The mystery is less why are stocks up versus why are parts of the market leading that really shouldn't be leading in an environment where rates are still climbing. But I do think we have an environment where, look, we're getting closer to the end of that Fed cycle, and maybe it goes a quarter point more than the market thinks right now, but we're still seeing the end of that process. We do have a better economic outlook with better nominal GDP. None of this means we're going straight up and you chase every momentum stock out there. But I think the reality is, in an environment where you avoid a recession, where nominal GDP is, let's call it 4 or 5%, and rate volatility is probably going to be lower by the end of the year, that's not a bad environment, and it probably leads stocks higher by the end of the year.
Okay, so based on that, how would you play this? Would you basically sell tech stocks, buy the rest, and perhaps not have as much in cash as people expect because this is an opportunity in other assets that people are discounting it too much?
Well, there's probably right now, cash actually doesn't look so bad right now, at least compared to some of the other parts of the curve, just given the fact that you are getting a lot to sit out. But yes, I do think you want to go back to something that is, judiciously embracing risk. Now, I don't think it's all about growth versus value. Matter of fact, in our portfolio, what we've been doing is we've been emphasizing two themes. We're still going for quality, and that's because we're in an environment where, again, the economy we don't think is going into recession, but there will be some deceleration, and we're splitting the difference on the growth value debate. We're going for GARP. GARP is a style, growth at a reasonable price, that tends to do really well when you have an economic deceleration, but not a contraction. So again, I think it's more about picking your spots, having companies with strong cash flow, rather than making these big bets on tech or not tech.
Hey, Russ, great to catch up and break some of this down with you. Russ Kostrick there of BlackRock. TK, to Russ's point, this is not about why equities are up. It's a leadership question. Why is tech leading in an environment where yields are climbing and people are pricing in a higher terminal rate from the Fed.
I would skew to this one word, quality, and people are looking at profitability and persistent free cash flow and putting a premium on it. The mystery to me on a fear of missing out Thursday is in the speculative area. It seems almost like a whipsaw of hedge funds and the type. They're in, they're out, they're in. Let me know what they are today. I'm not sure I know.
It was short covering in January. What is it in February?
Dan Ives.
At some point, and we'll catch up with Dan Ives a little bit later, at some point the theory has to shift, doesn't it? Don't you think? You can't keep saying the same things and just keep saying, yeah, it doesn't make sense, it doesn't make sense.
Don't
and then
give away our secret. John, don't give away our secret.
Goes on another quarter.
Okay, so first of all, we're coming up with narratives around something that is very difficult to really pin down. So understanding that sort of blanket statement at the outset. I do think that what Russ said there was fascinating about you want to go back to something that's judiciously embracing risk. This comes on the heels of better than expected data. And I wonder within the tech sector how much people are still riding on this idea of job cuts, allowing growth, allowing some of that profitability, that incredible sort of cash fortress that Tom points out to continue to attract investors. That said, the underlying thesis of the Fed having to go further just still kind of looms out there and continues kind of raising the pressure, the boiling of the frog that raises a specter that perhaps it won't work.
It's encouraged by the January data, for sure. So we've had a blowout payrolls report, 3.4% unemployment, 517,000 on payrolls, jobless claims sub 200K. We get another read on that a little bit later. And then retail sales with a 3 handle yesterday. It's too early to draw conclusions, but if you came into 2023 with a theory, and your theory was that the growth was going to have to decelerate, the Fed was going to back away, maybe we got a pause in March, you had to reassess the probability of that theory. And clearly, that probability has shifted some.
To the conversation with Mr. Kosterich, we talked about top line, not inflation adjusted animal spirit, and that's what you saw yesterday in retail sales. Those are nominal numbers. That's the top line number, and it's forget about all the economic babble that matters at some point.
Equity futures right now down not even 1/10%. Lisa's gone through the day ahead. We'll talk about claims later, tons of Fed speak. We need to talk to Peter Cheer of Academy Securities about what's happening with 0 days to expiry options.
Absolutely.
After Marko Klanovic of JP Morgan warned about possibly, what is it, Volmageddon 2?
Volmageddon 2.
Okay, Peter's going to define what Volmageddon 2 actually is. He's going to join us in the next hour. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. A warning from the Congressional Budget Office. It says the federal government would be at risk of a payment default as soon as July if Congress fails to raise the debt limit. House Republicans have threatened to hold off on lifting the debt ceiling until Democrats agree to cut future spending. Russia launched a major cruise missile barrage in Ukraine today. The Ukrainian air defense says missiles hit critical infrastructure facilities. They were launched from both the air and sea. Meanwhile, U.S. Defense Secretary Lloyd Austin says that Russian casualties in Ukraine are likely to mount. He called Russian soldiers ill-trained and ill-equipped. China will impose fines on Lockheed Martin and Raytheon for selling weapons to Taiwan. The fines are worth twice the value of the company's weapon sales contracts with Taiwan over the last 2.5 years. Lockheed Martin and Raytheon are also barred from exports and imports involving China. The FBI reportedly searched files at the University of Delaware, which houses President Biden's Senate papers. According to the Associated Press, the material that agents took does not appear to contain any classified documents. The president's legal team was said to cooperate with the FBI. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We look forward to working with our valued allies to ensure that we all do even more to invest in our shared security. We still have much more to do. Even as we rush to support Ukraine in the critical months ahead, we must all replenish our stockpiles to strengthen our deterrence and defense for the long term.
That was Lloyd Austin, the US Secretary of Defense, speaking in Brussels yesterday, just ahead of an important security conference in Munich, Germany. Touching down in Munich, Germany today, the US Vice President Kamala Harris leading a US delegation. We'll have plenty of coverage of that for you tomorrow with Maria Tadeo. Going into all of that, equities look like this on the S&P 500. Futures a little bit softer. No drama, as we often say. We're down about 1/10% on the S&P. Yields come in a couple of basis points on a 10-year, 378.38 after pushing higher over the last day or so. Pushing much, much higher on a 2-year. Very close, very, very close to 470 in yesterday's session after retail sales delivered an upside surprise. We just fell short at 469. We come back down this morning by 5 basis points, Tom. 458 on a US 2-year.
What we're going to do right now, John, is digress here with a little bit of history, which shows the tensions that we see in Europe. Long ago and far away, and for Americans, there is only one event of 1963. But for Europe, it was coming out of the immense difficulties, the Marshall Plan, the late 1950s. And one guy in Germany set up a conference, the Munich Security Conference. He was a resistance fighter. It was a Germany trying to find a way and find a path. And it was basically a meeting where the allies could measure how allied they were. With a brief on Secretary Blinken's trip today to the Munich Security Conference, Tina Fordham joins us now, geopolitical strategist, Fordham Global Foresight. You know, Tina, we don't have to trot out Konrad Adenauer or Willy Brandt of a Germany that desperately needed the Munich Security Conference a million years ago. How badly does Germany need this conference this morning?
Well, Germany needs the Munich Security Conference, and I would argue the U.S., the UK, and the world need the Munich Security Conference. It was great to hear you remind everybody how and why it was founded, and to remind our younger market participants, only a few years ago, these kinds of meetings were dismissed as talking shops. I would argue we're back to an era where the words that are used and the show of strength is actually critical in laying the groundwork for what's going to happen in the coming months and year ahead.
How allied are the allies, and where does President Biden and Secretary Blinken fit in?
It's really important because this conference has one objective only, and that is to communicate a unified front to the Kremlin when it comes to Ukraine. Now, Americans in particular have been skeptical that through winter with higher energy prices and inflation that's hit the European continent even harder than anywhere else, that this unity would prevail. What's really important, I think, and maybe diverging from expectations, is that public opinion in the UK, in the European Union member states, is robustly in favor of continuing to support Ukraine. So this is what I want to underscore, and that's despite doubling and tripling of energy bills and the cost of living crisis. So there's really no turning back. We do see mixed messaging, some stumbling, including from Germany on freeing the Leopards, as the great campaign went, the Leopard tanks, insisting that the U.S. Send Abrams tanks before. But the broad takeaway should be standing up to Putin and supporting Ukraine.
Tina, I like how you put that there is one goal for this conference, to protect unity to the Kremlin. How does the China debacle that we've seen with the U.S. and China and some of the tit for tat, the potential for some sort of meeting between Tony Blinken and Wang Wenbin of China, how does that sort of play into or potentially complicate that goal?
Well, it's a reminder that everything that the West and the G7 does to communicate about Ukraine has another meaning, which is consistency of position for Beijing. And so, as you rightly point out, these the kind of balloon hostilities that have transpired have been met by some pretty prickly rhetoric from Beijing. And, you mentioned the sanctions response on U.S. tech companies, Raytheon and others. They're not backing down. In fact, they seem to be using the hullabaloo over the balloon. Sorry, I just thought of that. In China to kind of poke holes in U.S. capability. So I think there's still a question about whether Blinken will actually have this meeting on the sidelines of the Munich Security Conference as scheduled. And that points to what diplomats say we need on the U.S.-China relationship, which is so-called guardrails, because hopes for the reset that followed the G20 meeting in December are looking pretty fragile now.
So I'll give you some of that fiery rhetoric, or prickly rhetoric, as you put it, from the spokesman of the foreign ministry, whether there's going to be some sort of discussion between Wang Yi and Tony Blinken. He said the balloon saga tests the U.S. sincerity and capability to properly handle crises and stabilize relations with China. What does it mean to properly handle crises?
To not inflame them. Not that I am a mind reader on the Chinese foreign ministry, but first of all, not to inflame them. The suggestion was that the U.S. overreacted. And then I noticed some weird communications coming from Chinese embassies in Europe about the train derailment in the state of Ohio. So there seems to be some kind of line of attack on U.S. capability. I'm not sure where that's headed, but what it doesn't suggest is that anybody's trying to de-escalate the rhetoric ahead of these meetings, which, as you know, tend to be incredibly well choreographed in advance.
Tina, wonderful to hear from you as always. Tina Fordham there of Fordham Global Foresight on the Munich Security Conference, which begins tomorrow. The relationship between Europe and the rest of the world, and particularly US and China at the moment. The latest news on that a little bit earlier this morning. Lockheed Martin and a subsidiary of Raytheon Technologies added to a list of so-called unreliable entities due to their participation in arms sales, Tom, to Taiwan.
Okay, well, I think it adds up. What I would say is from Tina there were, why do we do that? Why we're doing economics, finance, investment. These are changing tides, John. There were phrases she said I haven't heard in 45 years, 50 years. I mean, this is a huge deal. Now, Blinken's going, right, to the Munich Security Conference.
Well, Lisa mentioned that, and there's a possibility of a meeting between the Chinese delegation and the US delegation, and we'll see. I've got no idea.
These are
we'll
themes because of the war in Ukraine, and as she mentions the Kremlin, these are themes from another time and place, and I don't think any of us, including me, are prepared for.
Well, Tom, what it goes back to, as you know, is the breakdown of globalization over the last several decades. There was a belief for a long, long time that if the West included China, China would become more like the West. That was naive. Some people might call it arrogant. They were wrong, dead wrong. And now what we're seeing, some of the consequences of them being wrong is you have to pull back, and they're trying to unwind it all. Now, can you put the toothpaste back in the tube? I don't know, but they're going to try, and it's going to be expensive.
Let me ask you this, and I'm not asking for an opinion, but just the zeitgeist out there. Is the United Kingdom leading the way here on this bridge of allies? Is from Boris on to Mr. Sunak? Is the United Kingdom leading the hearkening back
it's
to
part
the
of the
60s
leadership.
and 70s?
It's part of the leadership. It's at the epicenter of that group of allies, without a doubt, and has been over the last couple of years. And obviously, Tom, this dates back decades and decades and decades. But that's not going to change with a new prime minister at all. Not at all.
Can I just weigh in on something that you said? This idea of, this really harkens to a new dynamic that will affect markets. John, you say that we've seen deglobalization. Perhaps we've seen the talk of it, but we haven't seen the action of it. And what the action of it will mean hasn't been really priced in.
Yeah, I don't think I said we've seen it. I think we're starting to see the beginning of that taking place, the unwinding of it. And that's going to be a story for us for a long, long time. Futures right now on the S&P, negative 0.1%, live from New York with yields coming in a couple of basis points. This is Bloomberg. Equity futures on the S&P down about 0.1% on the S&P 500. Big lift in the Nasdaq again yesterday. Year to date, the Nasdaq up something like 15%. This morning, down 0.06%. And the Nasdaq's been rallying in the face of this in the bond market, a 2-year that keeps on climbing. In the last 24 hours, very close to 470. In the bond market, we look like this on 2s, 10s and 30s. Your 2-year down 4 basis points, 458.47 on a 2-year. Call it 459 right now. On a 10-year, not doing much, down 2 basis points or so, 378.57. Ton of Fed speak again today. Mester, Bullard, Cook, all on the docket. Berenberg's Holger Smeeding weighing in on the role of central banks and saying this: although the past year has been rough, it has become clear since October that markets can rally even with less central bank support. I think, Tom, that is a really important observation.
It's an important observation from someone who just has been a terrific voice for Bloomberg surveillance on Europe. John, I just think it's so important to have Mr. Schmeeding in our studios here today, and particularly true because John holds the longest lunch at an ECB meeting in Frankfurt ever. Why don't you lead off the conversation, because you do know every long lunch.
That's if you can find a good restaurant.
That would be true.
Holger Schmeeding knows where they are. Chief economist at Berenberg joins us here in New York. Holger, fantastic to have you with us in the studio. Good morning.
Yeah, great. Good morning.
Let's start with your conversation with clients. When you come to the United States and meet with US clients, can you reveal their perception of Europe right now and how out of sync it might be with reality at the moment?
First of all, the perception has improved a lot over the last 3 months. It's still a bit too negative, I would say, still a bit out of sync, but not as much as it has been sometimes in the past. You know, we had these periods during the Euro crisis when hardly anybody in the US seemed to understand Europe, namely that it would get through it.
Neither did the Europeans, to be fair.
Actually, quite a few did. The further away you were from Frankfurt, the more misunderstandings you often got. But at the ECB, it was always clear, of course, we will not let our currency go under.
Sure.
We just need to wait for the right conditions to finally do this, whatever it takes. So the point is, yes, there is still some misunderstanding as to how Europe works and how Europe reacts to the Putin shock. But it's more open-mindedness now. The key question I get at the moment is, well, okay, the winter was mild. But is that just a mild winter? Is Europe really over the worst of the Putin shock, the gas price shock, the gas shortage risks, or will it all come back in the winter thereafter? That's the key pushback. And our answer is we are probably safe even for the next winter because we are using less gas even in temperature weather adjusted terms, and we've built up the facilities to import more. We are probably fine. Putin's attempt to blackmail us with a gas weapon has failed.
Okay, so that's the question we've asked too. It's great now. It's better now. What about next winter? Is that just about gas from elsewhere? Is it also about coal? How much has coal been a factor in Europe's ability to get through this?
Coal does not play a major role in this, no. First of all, we have a bit of coal. We can probably get coal from friendly nations such as Australia if we have to. And most of it is that, once again, gas. We will likely end this heating season with gas storage at 55% of capacity. A year ago, we ended the heating season with 25% of capacity. That is over the summer. We need 30 percentage points less of gas imports to prepare for the winter thereafter. So yes, we'll be using a bit more coal, but our need to use more coal is not so elevated that that itself could turn into a problem.
I've been shocked how people don't talk about nominal GDP. Japan showing sub 2% nominal GDP in statistics in the last 48 hours. America has a buoyant nominal GDP. We all know that. What about Europe? What is Lagarde's animal spirit, Lagarde's nominal GDP that's the backdrop for her ECB decisions?
Well, nominal GDP growth is, I would say, roughly above normal. We at the moment have, in annualized terms, very little growth. We are kind of in a winter stagnation. The nominal is still probably expanding at a pace of 4 to 5%, which is not too bad if you would have the split of 2% growth and the rest being prices. But at the moment, we have nominal GDP isn't the problem. It's the split between prices, and at the moment, no growth or very little growth, with, of course, the prospect that growth, the real growth, is going to come back by the summer at the latest.
And Lisa, the inflation numbers there are not the inflation numbers here. I mean, that's all there is to it.
What, you mean 10%, 9% is an incredible amount that hasn't really come down, maybe peak inflation in the U.S. Less confidence in that, at least over in Europe, although perhaps getting more confidence. I want to go to something that you're talking about, that it has become clear since October that markets can rally even with less central bank support.
Exactly.
How much is this because of the dominance of the real economy in European indexes? That it really hasn't been hinged to as many interest rate sensitive sectors as, say, the U.S.?
That is, of course, a major point. We did not have this huge run-up in tech, some of which was highly levered. And, of course, we have in our economy less importance of the really interest-sensitive sectors, such as over here, the home building sector, the residential sector. But the key point is it's a matter of confidence often. It's not just liquidity that drives markets. It is, do people want to use the money they have, to buy, for instance, equities, to buy risk assets. So it's not just, is there liquidity around? It is what people want to do with the liquidity. In a situation where central banks reduce the overall liquidity out there, but people become more confident. Look, Europe is actually not such a bad place. Let's buy something there. Equity markets in Europe can rally even with central bank liquidity going down, and the same actually holds for the world economy.
Well, part of this is because China came back online, right? I mean, a significant part of this is the reason why that's really changed the narrative. How much has that been overpriced? How much has that been overplayed, given the increasingly domestic focus of the world's second biggest economy?
I actually think that this China factor plays a bit of a role in market sentiment, but is not the key driver this year. For me, the key driver this year is that we realize all of the major economies are actually more resilient than expected. This seems to even hold for the US, where there is an economic slowdown, but we now have this discussion, will there ever actually be a landing? We still expect a landing, a softish landing, but we see in many European data, in many US data, in data pretty much across much of the world, yes, times are a bit tougher than they were, say, a year ago, but the worst scenarios are not playing out. And the China reopening story is a bit more like the icing on the cake for that, rather than being in my view, the underlying driver why we are getting back towards more risk on, or at least less risk off sentiment in markets.
Oliver Schmedding, with immense respect for your childhood and the tumult of Germany coming out of World War II, there's a fear of inflation that was pounded into us in America. I see 7, 8, 9% inflation in Germany. Does the Bundesbank panic at some point?
No, panic isn't the right word. Of course,
What's the right word?
The Bundesbank is very much on the hawkish side and would like to step more harshly on the monetary brakes than many others. That comes out of history. But even the Bundesbank acknowledges that the European inflation is, to a significant extent, and I would say almost exclusively, the result of Putin. This is unlike the US, where we have this domestically generated inflation coming out of the fiscal largesse in the early part of the pandemic. Over in Europe, inflation was a bit on the high side, but starting to peak when Putin started his war. And now the Putin shock, which is largely the gas price shock and the gas shortage risk, the Putin shock drove the economy down, prices up. And what we are now starting to see is the reversal of the Putin shock. That is the weird combination of getting better growth going forward and still lower inflation, which is not what normal economics would tell you. If it's a domestic inflation problem, you need a weaker economy to get inflation down. All we need in Europe is for Europe to digest the Putin shock, and that's what we are doing. And apparently, even with more success than economists like us had expected a few months ago.
Is that an expensive way of saying that Europe's problem's transitory?
Europe's biggest problem is hopefully transitory. That's the Putin problem, not in the sense of the war, that's a separate discussion how long that may last, but in the sense of getting simply used to, okay, there is no Russian gas for us, it's tough, we are adjusting to it, we can live with it, and we will be living without Russian gas forever onwards.
It's interesting to hear you say that phrase, fiscal largesse, because when I speak to European economists, and when we hear from President Lagarde, she says the same thing. What we're experiencing in Europe is different to what you've experienced in the United States. You had too much fiscal stimulus. Yet here in the United States, the administration will often say, it's a global problem. Is it a global problem?
There are two very different aspects here. The one is the US really in 2020 and 21 had far too much fiscal stimulus and had a bit of classical, you could say, overheating economy in the reopening bounce in 2021, and now you have to take that back. Europe does have a significant fiscal stimulus as well, but it is a multi-year stimulus, this Next Generation EU program, which means every single year it may add up like 0.2%. to Eurozone GDP, year by year by year. And that's exactly the right way to do it. If you want to spend more money and you have the need to spend more money, don't do it in one rush. If you stretch it out over 5 years, you will actually get something for your money rather than just higher prices.
Speaking of money, this is not why we had you here. Could Harry Kane actually go to Bayern Munich Is the great German soccer team going to steal the Tots' best player, the best player in the world?
Well, I must say I'm not into the details of that, but Bayern Munich has a habit of attracting global talent, and they are among the few European clubs who actually could pay the price if they had to. But again, I don't know anything about that.
No, but that's sort of playing the highlight reel, Holger.
Holger bought notes on that.
He did.
Wrote stuff down.
He nailed
Holger,
that.
this was great. Holger, thank you. Always a clinic. Thank you, sir. Holger Schmieding there of Berenberg, the chief economist, TK, on a whole range of issues.
This is what the show is about. Tina Ford and back-to-back with Holger Schmieding. And, this is great.
Holger's meeting with the White House tomorrow.
I learned, I'm sorry, I learned a lot.
To advise on fiscal policy. Didn't we get a date yesterday, a possible range?
Yeah.
For the X date, the so-called X date?
June, I believe, right? Or is it July?
Somewhere in the summer. I thought they gave us a range.
Somewhere in the summer. They gave us a range, and it could be sooner, and the huge deficit. The one issue that I had, and I wish we had more time with Holger, is that the inflationary push in Europe is pretty broad-based, that the core has been accelerating a bit more. So it's not all energy, and there is the wage pressure that you're seeing also over in Europe. So it's sort of how much does the stimulus, the big fiscal spending, also pair with regime change when it comes to the economic paradigm?
He's got a good European story to tell. That's what this is about, coming to the US.
It's a great European
story. Things are
story.
better than you realise. In Europe seems to be the message. That's reflected in the equity market. We mentioned that a little bit earlier. Record high in Paris, France, on the equity index over there. Record high on the benchmark in the UK, the FTSE 100, at an all-time high as well. Futures on the S&P here, down about 1/10%. Coming up, 7:30, look out for this. Deborah Cunningham, the global liquidity head over at Federated Hermes from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China is questioning whether the U.S. is genuinely looking to repair ties damaged by the dispute over a balloon. The foreign ministry called on Washington to handle what it calls an unexpected isolated incident. Later this week, the nation's top diplomats could meet at a security conference in Germany. Some new insight for investors on when the federal government will be at risk of a payments default. The Congressional Budget Office estimates it could happen as soon as July if lawmakers fail to raise the debt limit. Now, House Republicans want to hold off on lifting the debt ceiling until Democrats agree to spending cuts. In the UK, the National Health Service reportedly paid about $2.4 billion to private hospitals to help in the early stages of the pandemic. But the medical journal, BMJ, suggests that little burden sharing actually took place. And the findings raise concerns that the NHS wasn't making the most of the resources available to it early in the pandemic. Tesla has fired dozens of workers at its factory in Buffalo, New York. It comes just one day after employees there announced a union campaign. And that's according to a complaint filed with the National Labor Relations Board. It accuses Tesla of retaliating for union activity. The electric car maker has not responded. Air India could almost double what already stands to be the biggest aircraft order in commercial aviation history. The carrier has ordered a record 470 planes from Airbus and Boeing. Air India now says it options to buy another 370 jets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're seeing even customers with $100,000 household incomes, companies like Walmart, are seeing more consumers who have that level of household income. Some of the dollar store and even off-pricers, where their average household income they were getting was under $40,000, and now consumers with $60,000 household income are going there. The trade down is real.
The trade down is real. The message from Dana Towsey there, the CEO of Towsey Advisory Group, live from New York. Going into a little bit more data a little bit later. Jobless claims 8:30 Eastern Time. Equity futures look like this, down 0.1% on the S&P. Looking maybe to continue the bounce from yesterday on the Nasdaq, where we were positive 0.9% on the Nasdaq in the face of high yields off the back of blowout retail sales data with a 3 handle. We're still trying to make sense of all of this, Tom. A lot of head scratching going on. A lot of painful moments for a lot of people who did not expect this year to date.
Really, to go back to what just as a benchmark, the beginning of the pandemic, I put it Valentine's Day 2020. Have we been, to use a word from economics, have we been as bewildered as we are right now? I can't remember when it was like this. And I think maybe it speaks to how rate rises have come in. It's not easy now. We're not near gross accommodation. We're somewhere up there.
It's never easy. But some of the year-to-date gains have been phenomenal. We mentioned the airlines. Air France up something like 35% year-to-date. I've mentioned the US carriers a few times. United up 32, American up 32, Delta Airlines up 19. I mean, this is really phenomenal stuff, TK, that just keeps on grinding higher.
Yeah. I was in L.A. I'm on Sunset Tower.
Tell us a story.
And I'm driving down, and you know how they got banners on the light posts?
Right.
The whole thing down to the ocean, Pacific Ocean, whole thing down to the Pacific Ocean is Paramount banners.
Right.
And it was like they were screaming into Hollywood, pay attention to us. And I don't know if anybody's still paying attention to Paramount. I really don't know what they do.
Did you see what Spielberg said to Cruise?
No.
That Maverick, Top Gun Maverick, maybe saved Hollywood and saved the theatrical rollout of movies. That was the quote from Spielberg. And that's Paramount, isn't it? Top Gun Maverick?
Yeah. Pluto TV? I have no clue.
Well, I've got no idea what that is.
Showtime, they've got their own problems. Paramount Plus, they're the ones that have soccer games I don't watch.
They have the Champions League and Italian football.
Yeah, they have AC Milan, CAC Milan network.
I mentioned this in a break, so I'll share it with you. So over the weekend, I started watching Yellowstone. Fantastic. Okay. Brilliant. I'm late to this, I know, but I started with season 1. So I wanted to find season 1. Season 1 was on Peacock. The latest season was on Hulu. And I couldn't find it on Paramount Plus. And it's made by Paramount.
Okay, excuse me.
Can you make... I don't get it anymore.
Is Peacock Paramount?
No,
they're separate.
They're
separate.
Totally
okay, I don't know. Don't look at me like that. He's watching Yellowstone. I'm watching Jellystone. I mean, that's
I was trying to figure out. You're sitting there on the TV, just trying to figure it out.
Yeah.
That's kind of the problem right now with all of this.
Say it's a big problem. We're going to get a brief on that right now. Geetha Ranganathan joins us now. She's in charge of streaming idiocy at Bloomberg Intelligence. Geetha, how big is Paramount Plus? I mean, we talk about a subscriber blowout, but come on, are they like to Netflix teens weens? Are they in the game? Where do they fit in?
So Paramount Plus, no, they're nowhere near the scale of a Netflix or a Disney Plus. They have about, we think by the end of 2022, they would have had probably about 55 to 60 million subscribers. The thing with Paramount Plus is they have great breadth of programming, and they've had a lot of success. So they've really surpassed expectations. The question is it enough to be a standalone business? Is it enough to be viable? I don't think so. That said, they've still done really well, relatively well in the streaming wars, just given that they had a pretty late start.
What will be the catalyst for combinations within a non-profitable streaming industry?
Yeah, I mean, this is the big head scratcher with Paramount. They have a great collection of assets. You mentioned the, Top Gun. They have a great film studio, some great franchises. We have Mission Impossible coming out a little bit later, Transformers. Transformers. So they do have a great pipeline. They just don't have enough to be viable on their own. So the big question is this going to be an M&A target? I think most people think it will. There's been a lot of interest from Berkshire and Warren Buffett. He has almost a 16% stake in the company. But again, fundamentals on their own, not looking too great.
Okay, we talked earlier with respect to Disney Plus and some of the others that now platform is king and not necessarily content in the same kind of way. Would a Berkshire Hathaway takeout be what really is most effective for Paramount, or would it be an Apple? Would it be some company that could merge it with another platform that could give it more visibility?
Absolutely. I think at the end of the day, it is definitely going to come down to M&A. The problem with Paramount Plus is it still has substantial exposure to the linear TV business model. And that's a business model not many people want to get into. So almost 60% of their revenues still come from, linear TV, whether it's TV advertising or affiliate fees. So I think eventually when there is an M&A deal, it will have to be pieced out. So maybe the streaming platform goes to a particular player. The studios definitely are the most valuable part. Apple has been a name that's come up many, many times. Could also be another media player like a Comcast. You mentioned Peacock, Comcast, or maybe a Warner Brothers Discovery. I don't know, but we'll have to see.
What's the model that people are talking about? John was talking about the difficulties of trying to find anything and finding one season on one platform and another on another. Is this going to be bundling? Is it going to just be mass roll-ups? What are people talking about right now?
I think it's a little bit of everything. I mean, eventually there is going to be consolidation. There has to be a streaming shakeout, and we probably see about 2 or 3 major must-have services and all these other smaller niche type of services kind of rolled out into those big dogs, if you will. So, it is going to be consolidation, but as you mentioned, discoverability and the power of the platform is really, really important. Paramount, unfortunately, because of their size, they haven't necessarily been able to go all into streaming. John just mentioned how, certain seasons of Yellowstone on certain platforms, and here again, they can't pick a lane. I mean, in the streaming wars, we've always asked companies to pick a lane. Paramount, unfortunately, doesn't have the luxury to do that. Brilliant. So they have to license out some of their content. They have to keep some for their own. So, you'll see 1883, 1923, which are the Yellowstone spin-offs, are on Paramount Plus. So the newest content on Paramount Plus, but any of the older seasons, you got to go to other platforms.
Agatha, we were also questioning the future of the movies that were being made and how they'd be rolled out. In the pandemic, I think many of us felt like it was the end of going to the movie theatre and watching the latest release. And then you had what happened with Top Gun Maverick, where Tom Cruise just said, wait. We're going to wait, and you're going to have to wait even longer until this can be available at movie theatres. Geetha, how much did that change the game?
It absolutely did. I mean, your quote about Steven Spielberg, I think that is absolutely true. In so many ways, we've seen Top Gun Maverick kind of really resurrect movie going in such a big way. And then we've seen, so many other movies perform really well too. Avatar, of course, is the latest example that has just done so well. And Top Gun Maverick itself, over 1.5 billion at the global box office. And I think what this has really done for studios in general is it's told them that, theatrical is really the way to go. And if you have a big blockbuster that should be seen in theaters, it absolutely should be seen in theaters. That said, I mean, box office has recovered, but I think we're still not going to see the numbers that we used to see before, which was $11 billion in ticket sales at the North American box office. So a lot of the smaller movies are definitely going to go to streaming platforms. But if it's a big budget, big blockbuster, it definitely is going to go to theaters.
Loved that movie. Just absolutely brilliant. Geetha, thank you. Geetha Raghunathan on the latest.
I love it.
Paramount numbers coming a little bit later. I can sense from your face and the way you've looked at me that you haven't watched Top Gun Maverick and you still haven't watched the original, have you?
Okay, guys, I haven't watched Top Gun.
TK, you are killing me. It was in one look, Bramo. Yeah. One look, I knew straight away. How have you never watched that movie?
Dear, don't speak to me like that,
How has that not happened? How's that not happened?
I've got so many other things to do. I can't.
Let's talk about your childhood.
TK, it's so good. I cried in Top Gun Maverick. I get that emotional watching it. I get emotional on planes. Right if I see someone watching Top Gun Maverick and I see a certain scene, I'm like, here we go.
I haven't seen Yellowstone.
I cry more watching any movie on a plane.
Always.
Why
always.
is that?
I've got no idea. I'll tell you a story about the British Marines. My brother-in-law.
Please, the
original Top Gun. So they would play a game with the original Top Gun, and him and his friends could hit pause on the original Top Gun on any scene, and they'd all know the next line of the movie. They'd all know the next line of the movie, Tom. How cool is that? People memorize this stuff. They love it.
Can I say that I believe some people are saying they actually have a chance to have a real movie like Top Gun win the Academy Award this year?
How much is this also, though, the love that you talk about for a franchise, those franchises really leading out front with some of the sales and the new movies. I think that's interesting.
Well,
less risk.
There's less risk. You can put the budget in and people come.
The difference here is John tears up at Top Gun. I tear up at Ted Lasso.
When's the new season out? When's the new
March
season?
1st.
Oh,
be there.
Cool. Okay.
Mandalorian as well. Favreau's coming out with another spread,
Nice. All right, I look forward to that.
I watched Ted Lasso, I'll admit to that.
I look forward to this. Peter Chia of Academy Securities is going to talk to you about what 0DTE means. That's next.
There's a lot of things that the market is getting wrong right now.
We were mispriced, I think, for the path of Fed policy. And now I think we're getting back to a more realistic level.
Now the market's starting to think the Fed's going to go further than they are communicating right now.
Some of this rally is chasing. It's the FOMO rally.
We are in an every data point matters type of environment now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's a snapshot of the year so far. Yields are up. We're pricing in a higher terminal rate at the Federal Reserve, a higher peak rate, so to speak. And tech stocks are outperforming. We're going to try and figure that out for you from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures right now basically unchanged on the S&P 500, but that tech outperformance, TK, in the last 24 hours continues.
Almost got down to a 17 VIX. That's a huge deal for me. This is a regime shift from a 21, 22 VIX, Standard & Poor's 500 vol, down to 18, 19. We're at 18.51 now, but yesterday afternoon, almost to a 17 handle.
Off the back of decent data, Tom, retail sales with a 3 handle, a blowout jobs report, jobless claims around 200K,
GDP.
And yields at new highs for the year.
Nominal GDP, just the animal spirit that's out there. The roses, you bought the February 14th roses. I bought the February 15th
What did
roses.
you get on February 15th? What was the sale like?
Thank you.
20% off?
No, we did better than that. We did about 28%.
Oh, good. I hope Mrs. Keene's not watching this morning, Lisa. 28% off on her
You know
flowers.
what's great about this show?
That's what he focuses on for Valentine's Day.
For those of you, the inside baseball here is people watch us and listen. We're so honored by Global Wall Street. It watches us. There's a guy down in Florida who lives on the beach. He's made it big. His name is Doug Cass.
Okay.
He goes out and trolls on the beach waiting for famous people to walk by. So a couple days ago, Michael Nathanson walks by. Cass has got his floaties out. He's ready to go into the ocean. He corners Nathanson.
And wants a call on
Paramount. And one of Cass's calls for Paramount is Paramount to be acquired by Berkshire Hathaway Apple Consortium.
That's what Lisa mentioned as well. And there's going to be a story for us a little bit later this morning when we get earnings. I'm going to whip through the price action. Lisa's going to go through the day ahead because we've got a guest in the studio I want to get to pretty quickly.
Yes.
Futures are unchanged on the S&P 500. No real drama here. Yields are coming in a couple of basis points after pushing high yesterday. Lisa, your 10-year, 378.38.
To build on what you were talking about around the head-scratching rally in tech, how much is this disinflation a head fake? And the 8:30 a.m. data that we're going to get, I think, will really speak to that. The PPI, in addition to the jobless claims and housing starts and building permits, and the housing start side, you're starting to see optimism really surge back with lower mortgage rates, at least briefly. PPI, how much disinflation are we truly seeing in goods, especially as you see the likes of used car prices start to tick back up? Today, European central banks speak. They're getting in on it too. Bank of England Chief Economist Hugh Pill, Deutsche Bundesbank President Joachim Nagel, ECB Executive Board Member Philip Lane, everyone really taking a look at that 2-year yield. And I keep going back to what Holger Schmieding said over at Berenberg, this idea that even with less accommodation from central banks, stocks can still keep rallying, but perhaps bonds are having a bit of a tougher time on the front end, giving you that kind of yield. And today, the Fed speak includes Cleveland Fed President Loretta Mester, St. Louis Fed President Jim Bullard, and Fed Governor Lisa Cook. Perhaps they can speak about the meme stocks.
Some ECB speak and some Fed speak as well.
She's great. I'm waiting for her to have Japanese speakers come up.
That's
who's speaking for the BOJ today?
We've got to find out, haven't we?
Bramo.
We don't know after Kuroda. Has that been confirmed? Ueda?
Yeah.
Is that confirmed
yeah.
now?
Yeah.
That's
He's confirmed?
Well, it hasn't been confirmed, but he's the nominee, right? He's the one that's going to be the person. And the question is, does it really change anything?
Good to know. Peter Cheer, good morning to you. Alongside us in the studio, good to see you. The head of macro strategy at Academy Securities. I said thank you, Tom. Thank you.
I'm just kidding. I'm just being obnoxious.
For those of you in radio, the cheer charts are something.
Is he logged into the Bloomberg already?
Well, of course he's here.
Always. I live on Bloomberg. I got to admit that.
Well, Pete, that's good to know.
Mike showed him the door when he came in.
Marko Klanovic of JP Morgan made some headlines in the last 24 hours. He's had a difficult time calling this market over the last 12, 18 months. The US equity market anyway. And he had this phrase, Volmageddon 2.0. And in it was this acronym, Zero DTE, 0 days to expiry. And I think a lot of our audience are hearing more and more about those options. Can we have a bit of a clinic here? Can you define for all of us, what is 0 DTE and what is it doing to this market?
So every day now they create options that expire either that day or the next day. So there's a huge volume in that. And there are weekly options as well. So Single stocks tend to be more weekly. ETFs tend to have the daily. And volumes have just been driving through that. And I think it has a couple repercussions. One is people are really literally gambling. And you can sit there. There's a Bloomberg screen called MOSO, which is the most active traded. It's almost like watching a horse race. You'll see the SPY 412 calls, then the SPY 413 calls, SPY 14. It's almost this laddering. So I think people are trading a lot of this. Volumes have exploded. I've heard as much as 40% of equity volumes can be related and tied back to the hedging of these single-day options. So it's a very massive driver, and I think it's why we're seeing moves just that are amplified. So maybe something that would be a 0.5% move based on the news becomes a 1.5% to 2% move, and it's going in both directions.
You touched on it briefly. Can you explain how this becomes self-fulfilling for the people that, let's say I am an institution and I sell you some of these very, very short-dated call options? What do I have to do on the other side, which leads to this becoming somewhat self-fulfilling?
Yeah, so let's say the day starts SPY at 400. And someone buys a 405 call, way out of the money, right? 1.25. All of a sudden, as it starts going to 403, whoever sold that call has to start buying SPY, which tends to exaggerate the price move. Then it starts getting to 405. They've got to buy more. And then what we're seeing happen is someone starts buying the 408 calls. And that starts putting pressure. And you see almost this laddering type trade. And it occurs over and over. And I think it reminds me a lot of what we were seeing about 1.5 years, 2 years ago, where you kind of had those gamma squeezes. And that was very much individual stocks. It started on Monday with people buying the weekly options. And now it's moved down to this daily option. And it's the other reason I think VIX is kind of irrelevant to me. So VIX only calculates options with 27 to 35 days of expiration. Right. As more and more people gravitate towards these daily options.
To the roulette machine, yeah.
Yeah, and the volatility doesn't get picked up in that. So I think that's where the surprises are going to come. People are looking at VIX for the hedging. It's all occurring in this daily and weekly options.
Let's do Myron Scholl's 101, 1998. It's a rule of thumb. Options are derived out of 4 times leverage. Futures derive out of 10 times leverage. With these short-dated options, what is their leverage equivalent? It's got to be way higher.
Way higher. I think it's the hundreds to one. People
really
like
that high? You're going to go way out past futures.
Oh yeah. Again,
when do the regulators step in here? This is a train wreck waiting to happen. You and I know it.
I think people are going to start looking at this. It's really hard to figure out what justifies this. You're starting to see, again, all like the meme stock type things where my Twitter feed's filled with people who promise to make $1,000 into $100,000 because it's truly gambling. There's no binomial model or anything that's going to predict this, right? You buy something out of the money and you hope it triggers. And what we're also seeing, I think, if you look in the background, on the days calls are working, people really push hard on some of the most shorted stocks and vice versa.
So to stay away from the jargon, gamma, folks, is basically a form of acceleration. What is going to happen is we're going to have a level change due to news, whatever. Equities are going to go up or down. What will then happen to the people playing a one-day duration in a leverage way out past 10 to 1?
Well, the people who get it right are going to make a lot of money. They're going to keep pushing.
What about the others?
That's where you'll see liquidity start pulling back. And I think that's what happens now is you've got all these algos kind of with this full level of liquidity, right? They're all kind of scalp a tiny bit. And as these moves start, they pull back.
Do you believe there's risk here on major Wall Street firm desks?
I don't think it's there as much as individuals, though I think it's really has started gravitating more and more towards, retail, not just retail traders, but institutional traders are gravitating to this. You're not getting these types of volumes because it's mom and pop or the kids playing. This has definitely hit the big institutional desks as a trading strategy.
What's the larger consequence of this? Is it a matter of just really muddied signals from a market that doesn't really cohere with any of the larger economic trends? Or is this something that's a more significant whipsaw waiting to happen and a sort of unexpected downdraft that could happen suddenly?
So I think the first thing is it's just much harder to get a good read on the market, right? These moves are amplified, so you can't see that. You've got to be watching these things or else you're going to miss signals. I think the most obvious day was the Thursday after the FOMC when NASDAQ was up 500 points. You could just see this really trading through these 0-day to expiration options. So you've got to be watching this. It dilutes information. And I think you just have to be prepared that whatever you think it can move, if you think it's a 1%, 2%, 3% move, you could get 5 to 10%, I think, much easier.
So is it just a matter of volatility, or does it also affect the trajectory, sort of the directionality, and also the persistency of a rally because of the self-fulfilling aspect?
I think it can. It can make things extend a little bit because it just makes it, if we live in a world where there's kind of almost windshield wiper algos, you're looking to who you can stop out, shorts or long, it makes the chances that they hit triggers higher, and then you keep pushing it higher and higher, right? And you get these much more exaggerated moves, which forces everyone who's short to close out. And now I think you switch back. And the other thing I think it has really done is, as a contrarian, you're always trying to figure out, okay, what's market positioning, and you want to bet against that. I think market positioning now turns on a dime. The ability to move huge amounts of risk through relatively short-dated options, I think, has changed that risk positioning. So it used to take weeks to a month for everyone to go from overbought to oversold. I think these things happen in days or weeks now.
So what's your projection of how this plays out? We've heard all these cute narratives trying to pin off the heels of certain market action. How does this play out as you see the boiling of the frog with respect to higher rates in the front end?
If it's like everything else, I think what we'll see is one down day where we go through some of the triggers that, stop the exchanges, and then regulators will pay attention, because no one ever pays that much attention when the bias tends to be higher. I think it's going to take a big down day where no one can explain why it's this. We start hitting all these triggers on the NASDAQ and New York Stock Exchanges.
And is that the Volmageddon 2.0 that Marco's talking about, a kind of repeat of early 2018?
Yeah, and I read a bit of his. I think it's a little bit off there, because the one thing that we had in 2018 was people trading the VIX directly. There were all those VIX ETNs, and they had that ability to actually trade the VIX futures, and there were really interesting trigger points at 4 to 4:15 p.m. that let people push that. But yeah, I think we'll see this, and I think you're going to see how I look at liquidity, whether it's in the bond market or equities. Again, it's all these little algos fighting around, and as soon as they start losing money, they start shutting off, and bid offer goes wider, and that's why you're going to see these exaggerated moves.
I hear now anoint to Cheerageddon.
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 Or Cheermageddon.
Cheermageddon?
Cheermageddon's better.
Okay.
They're trying to be cheerful in 2023.
Control room. Pharaoh's smarter than me.
I think that's great. Have you watched Top Gun before?
Of course I have.
There we go.
I don't know if you saw, but ahead of it, one of our the generals and admirals I work with, General Wallace, was actually a Top Gun instructor. So that was pretty cool hearing his stories about that.
What did he say? Did he like the movie?
That I should watch the movie.
He said that the movie was fairly realistic. There were all sorts of people at this, and there were some people who were just phenomenal pilots, not necessarily great people, but phenomenally pilots, and there were others who were great people. And it really was because I think it was in the Vietnam War, our kill rate had gone down so much, they felt the need to train better.
Amazing. Pete, this was awesome. Thanks for being with us.
Can you come back like in 3 days when we look at Cheermageddon?
Well, what we've got to talk about with Pete is the object's being shot out of the sky. I mean, Academy Securities is perfectly placed to have this conversation.
He is. He probably has a
We have spent a lot of time on that.
I know you have. Peter, thank you. As always, Peter Cheer of Academy Securities. Futures right now down 0.1% on the S&P. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A warning from the Congressional Budget Office. It says the federal government would be at risk of a payment default as soon as July if Congress fails to raise a debt limit. House Republicans have threatened to hold off on lifting the debt ceiling until Democrats agree to cut future spending. China will impose fines on Lockheed Martin and Raytheon for selling weapons to Taiwan. The fines are worth twice the value of the company's weapon sales with contracts with Taiwan over the last 2.5 years. Lockheed Martin and Raytheon are also barred from exports and imports involving China. There is a report that Russia has lost at least half of its tanks since invasion of Ukraine almost a year ago. Now, that comes from the U.S.-based Institute for Strategic Studies. It says Russia is using older equipment as replacements. The FBI reportedly searched files at the University of Delaware, which houses President Biden's Senate papers. According to the Associated Press, the material that agents took does not appear to contain any classified documents. The president's legal team was said to cooperate with the FBI. And Fidelity is bucking the trend of financial industry firings. The Boston-based firm wants to fill about 4,000 jobs by mid-year. Fidelity says the new positions will focus on customer service and technology. Now, that follows a year record hiring that brought Fidelity's headcount to 68,000. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Some of our Republican friends in the House are talking about taking the economy hostage over the full faith and credit of the United States. They say, unless I accept their economic plans, and which is totally irresponsible, they're not going to pay the national debt. Now, I made it clear in the State of the Union, I will not negotiate whether or not we pay our debt. I will not allow this nation to default.
That was the President of the United States on the big debt ceiling debate that's going to ramp up a little bit later this year. From New York City this morning, good morning to you. Equity futures down 0.2%. The equity market just a little bit softer, light to lower, negative down just a touch. Yields come in a couple of basis points on a 10-year. Your yield right now 378.38, and your 2-year backing away from the highs of the year of yesterday. Your 2-year coming in 4 or 5 basis points through much of this morning. We're down about 4 basis points now to 4.59. Yeah. Your next stop for this market about an hour and 13 minutes away, looking for jobless claims and potentially, Tom, another tick higher in claims for a second week, but still in and around 200K. That's a phenomenally low number.
Of a fully employed America, we've disinverted from negative 90 basis points in the shock yesterday of retail sales to negative 81 basis points as well. Public notice here, a number of people emailing, and thank you for watching and listening. Peter Scheer, John, I know you use this way more than me. MOSO is the major options screen on the Bloomberg. If you have a Bloomberg terminal, I don't think it works on your cell phone, but on the terminal, MOSO is this conduit into the Peter Scheer world.
I know I'll offend a lot of people by calling it like, watching the casino, the roulette wheel in real time.
Yeah,
I think I'm going to get a lot of hate mail.
He basically just said this.
I didn't mean that. Some people might say that that's what that has been.
This one take the lead and think this coming up.
That's how he described it.
No,
that's
exactly.
That's how he described it. That's
exactly
not my characterization.
I was in a McDonald's yesterday, and a guy came up to me in McDonald's. Thank you for watching. And he was talking about housing and rents and all that. And John, I went back and looked at rents in Manhattan. This is data off the Bloomberg, but I've done apples and oranges. From the beginning of the pandemic, Valentine's Day of 2020, rents have gone up 19% in New York City, 3,400, make it 3,500, up to 4,100. What's critical is to do some form of income approximation. In the same period, the income, the average income, and not a fancy people watching Bloomberg surveillance, is up about 6.5%. And that delta, to me, is the only conversation.
It's not going to get it done. Tom, increasingly this city is becoming very, very expensive to live in.
And I don't buy the idea
expensive.
It's better in Kansas City. It's different dynamics in Kansas City between rent movements and income movements, but it's the same angst across the nation.
It wasn't so long ago. I remember the banks would come out and they'd say, we're sending part of the bank to wherever it might be. And you'd be like, oh, you're getting sent away from New York City. That sounds terrible. Now all of a sudden everyone's like, you know what? Does the salary stay the same? What happens with the salary when I move? Because the cost there seems so much better.
Well, but that's the problem. And that speaks to what Tom's point is, that a lot of these places like Austin, Texas, for example, the prices now are sky high there as well.
Right.
But yes, to your point.
Isaac Boltansky joins us now with BTIG. I'm going to rip up the script here, Isaac, and I want to talk about your Ohio. There's a small chemical spill out in Ohio. It really is not on the elite East Coast radar. There's been a lot of criticism of that as well. Should we be paying more attention to train derailments in your Ohio?
Yeah, I think if you look at the actual data around train derailments, this happens a lot. And this is a regular occurrence. It's just that the actual impact that we're seeing in Ohio and the visuals are uniquely stunning. And this is something, Tom, that I think if we talk about trying to move from the rhetoric or the visuals of this event to what the actual policy discussion is going to be, Tom, what I'm hearing from folks on the Hill is, well, you know what? Pipelines are very often more safe than trains, especially when you talk about trains going through populated areas. So that's where you're going to see the policy conversation move.
To me, the elephant in the room, Isaac, is in the inflation data that we've covered in the last couple of days is housing in America. And I really take issue with the New York City conceit that it's terrible here, but it's fine out there. I just don't believe it for a minute. What can Washington do about rent and home ownership mortgage payment policy? What is the to-do?
You know, Tom, I spent a lot of time working on mortgage policy, especially with Fannie Mae, Freddie Mac, and FHA. And I think there's one thing that policymakers struggle with, which is our mortgage finance system is national, but our housing dynamics are all local. And so some of these pain points in certain cities that we've seen rapid growth in particular since the pandemic, there is no simple solution, right? There is an undeniable supply crisis. And there was an opportunity to address part of this with the most recent IRA bill. There was a discussion about sending money back to the states in the form of block grants and saying, we'll give you money if you do zoning reform, and trying to use that to spur growth, which we've seen in certain municipalities. But really, Tom, I'm afraid that from a federal side, all that we have is trying to turn the dial on demand even further. So there's talk of cutting pricing at the FHA, for example. And as you and I know, and you discussed before, this isn't a demand problem in housing. It's a supply problem. And so I am fearful about what that can do to marketplace dynamics, especially when the FHA, for example, is already seeing 6% early payment defaults. And you're starting to see some cracks in the data around credit performance in that asset.
You mentioned the IRA, and you do wonder about stimulus going forward, given the CBO report that we got yesterday and the upcoming fight that we're expecting. How did the report yesterday color your thinking about how the debt ceiling debate and potential debacle goes down?
Lisa, that one dropped like a lead balloon. I mean, the numbers in there were absolutely atrocious. There were, we have a $1.4 trillion deficit for this year. That's going to average $2 trillion per year through the 10-year budget window. We're going to see federal debt held by the public go from $25 trillion this year to $46 trillion in a decade. Not to mention, and this is the one that isn't getting nearly enough attention, the CBO says that the Highway Trust Fund, Social Security, and the Medical Trust Fund, the Hospital Insurance Trust Fund, are all going to be defunct in a decade. You wrap it all together and say that I am worried that DC isn't focused on some of the real drivers of our fiscal issues, which are entitlement spending and some of these longer term dynamics. Instead, we're going to have a fiscal fight over the debt ceiling, and it looks like that fight is now going to happen in the June to September timeline, with September probably being the date that most investors need to circle on their calendar.
So when people are in the market listening to this, is that basically that you're going to start to see T-bill rates shoot up violently short-term, like 3-month, 1-month T-bill rates?
Yeah, look, I think from a practical perspective, that's what we're going to see here. As we hone in on that X date, when the government's extraordinary measures will be exhausted, which again, the CBO is saying will be between June and September. I'm telling you, I think that this Congress, no matter what, is going to punt that deadline to the end of September for 2 reasons. Number one, sequencing that aligns it with the federal funding deadline that is also at the end of September. Number two, no one likes to be in D.C. in August, especially lawmakers, so they'll want to push this fight into September. And so, yeah, Lisa, I think that that's what we're going to see as one of the downstream implications of this is pressure in the marketplace, especially in that time frame.
Isaac, see in September, because that's when everyone's going to start caring, because right now, hardly anyone does. Isaac, we'll see before then. Of course we will. Isaac Voltansky there of BTIG on the latest. Here's the latest from HSBC. From staunch bears to lonely bulls. This from Max Kettner.
Oh, there we go.
I don't even have to scroll down to find out.
Give the history of Max, though. It's important for our
So Max came into this year very underweight equities.
Yeah.
He was underweight through most of last year. Max underweight is what Max would say. And then he came into this year and he got more constructive quickly and pushed against the consensus that we would get this first half dip and second half rip. And he looked for performance in the first half. He said, we currently find ourselves as pretty lonely bulls in a crowded pack of bears. We think the Goldilocks backdrop is set to stay and answer the most frequently asked questions on our constructive view. The note goes on to do that. We are overweight equities versus DM sovereigns, overweight the Eurozone and EM equities, and so on and so forth.
He's catching up with Binky Chadha and John Stolfus. Stolfus, I mean, he was a little bit slow there. We covered that last year, and all of a sudden, Stolfus looks like a genius.
Well, he had a tough year last year.
He had a tough year last year.
He's having a better year this year.
Max,
Max had a decent year this last year and is having a decent year this year. Equity futures right now, down 0.2 on the S&P. More than that still to come. We're trying to have a better year together, Tom. Come by all that good stuff. All right? You'd go to a restaurant and order the soup.
Yeah.
You'd actually do that.
There are entire restaurants devoted to soup.
What, as a main course?
I mean, yes, of course.
Explain Soup Guy.
That blows my mind.
Explain Soup Guy to the foreigner.
I mean, it's fantastic.
What's Soup Guy? What is this? What is this part of New York City I know nothing about? What is going
A
on?
Seinfeld episode where this guy was really mean and you had to be nice to him, otherwise he would say, no soup for you.
I've never seen that. I've never seen that.
Well, now you have.
Okay. When my mum used to make soup for dinner, we'd be furious.
Really?
As children, oh, without a doubt, we would protest in the kitchen.
Maybe that's a
How
testament
dare you feed us soup?
to how good a cook she is, because when I make soup, my kids are very happy.
In a more sensitive time, they called him the soup Nazi. That was like in the show.
Who's the soup in the show?
In the show.
They'd call the
In
guy
the
soup
Seinfeld,
Nazi.
yeah. And literally, he was on a side street down in Midtown. I was down below 59th Street. I think it was 7 years ago.
That is amazing.
Yeah, things you learn every day here in America.
I just thought I'd continue the conversation from the commercial break into live programming, just so you all had a decent idea of what happens behind the scenes.
No, we
which
want a
is
big little ads.
Not a lot.
No, we're working on this for after the 4th of July. We're going to big little ads so you can see us in the break.
Like sports.
Like
I've said
sports,
this for ages.
Big
like
little,
sports.
our wonderful advertisers.
As they're all
are
sort
on
of
board.
standing there singing and they shake hands and then the betting comes up on the other side.
Yeah.
Like, we can do that with zero DTE, latest options pricing.
MOSO.
All of that stuff. Whatever. Futures right now, down 0.25% on the S&P. We're a little bit softer, backing away from the gains of yesterday, both in the equity market and in the bond market as well. I'll keep this brief. The Nasdaq had a decent day of gains in the face of higher yields, and we're still trying to work out why. The 2-year yield looks a little something like this in the bond market. A 2-year backing away from close to 470 in yesterday's session. Lisa, right now down 3 or 4 basis points to 459.32.
All right, let's take a look at some of the recent movers, in particular, some of the companies that have reported earnings. Roku, those shares were lower by something like 80% last year. They're up about 11.6% right now after delivering better than expected fourth quarter earnings. You don't understand
What
Roku,
is
I can
Roku?
tell.
Just
I can
for
understand.
our viewers and listeners, what is Roku?
It's so amazing. I can just look over, see your face.
No, what is Roku? I don't know what it is. I know what
box.
Apple is.
Well, it's that device that you can operate your streaming services on. And they have, basically, you can put in some sort of chip or some sort of device that then allows you to stream on any screen or on Roku-specific screens. Okay. So it's basically tied to the streaming wars. It did amazingly during the pandemic. Then it was the post-pandemic hangover, and now it's basically growing. What we're seeing from Paramount, we were talking about Paramount earlier with Geeta Ranganathan, and it came out with earnings. They missed their earnings in the fourth quarter, and the shares are lower by 6.7%. But the interesting thing to me is they're not being rewarded at all for having record subscriber gains and better than expected subscriber gains. So right now, it's all about the money, not necessarily subscriber numbers, which I think speaks to the moment that we're in. I also think that it's interesting to see Hyatt Hotels. They beat their expectations. Not surprisingly, those shares up just 0.4%. But John, this really speaks to what we've been talking about routinely. People want to travel. They are spending on travel, and the travel companies are delivering massive results as a result. And you're seeing this across the board, whether it's airlines or hotels.
Do you want quote of the day? Quote of the day from Oksana Aronov from JP Morgan. This is great. Just pinged me a message. Bonds are back is all I hear everywhere. The last time this many influential people said something was going to be great was Fire Festival. Isn't that brilliant? I think that's absolutely brilliant.
She's trolling on the whole market.
TK's giving me the eyes like, what was Fire Festival?
That was that
I'm just
festival.
not. Forget it. I'm not explaining it. If you don't get it, you don't get it. Like, I'm not explaining the joke. The line is right there.
Yeah. Either does Deborah Cunningham not get it, Global Liquidity Markets CIO, Fed she joins us today. Deborah, I've entered your world more in the last 7 days than I have in the last 7, 10, 12, 15 years. And you know, Deborah, you own it, the BTMM screen on the Bloomberg. Explain why the BTMM money market screen is so interesting now. Why are we so interested in short-term paper?
Well, if you look at 2022, Tom, it was really the only positive asset class, and expectations are that it's probably going to match, if not beat, most asset classes' returns in 2023. The products that we have in the liquidity space on that BTMM screen, if you call it as such, that are investing in commercial paper, treasury securities, short-term discount notes from government agencies, repo, they are yielding anywhere from 4.5% to 5% at this point, with the expectation that the Fed's going to go higher by another 25, 50 basis points. So their yields will continue to rise. So even if you look at bond yields getting up to 3.5%, 4%, with maybe a little appreciation for the year, you're probably not looking at much more of a return than 5.5%. You're kind of already guaranteed almost from a money market fund perspective.
Is your world running smoothly? Is the liquidity in the market, the fungibility, the back and forth of the short-term paper market healthy?
It is healthy. In fact, the short-term commercial paper market is at its peak in size in probably since post-pandemic or pre-pandemic. So it's almost 1.3 trillion at this point, and it's a healthy mix of financial firms, various industrial firms, different types of retailers. You've got pharmaceuticals in there, oil and gas making up a large part of it. So it's a diversified and growing sector of the market that has a lot of buyers at this point. So yes, the give and flow, two-way, buyers and sellers in that market are pretty healthy right now.
Deborah, I want to go to what Oksana Aronov said, because not just about the Fire Festival, and I think it's a great line, but also it highlights this discomfort with everyone saying bonds are back. This is the place to be. It is incredible. What's the pushback, right? What's the potential risk developing when you get such a solid consensus?
Well, I think the concern is rates go too low. And therefore, the combination that I think with the bonds are back speak is a combination of what you can get from the coupon or the yield on the product, as well as maybe a little bit of potential, growth from an NAV standpoint. So your total return, being up in the 4, 5, 6% area. The concern is if the yield gets too low, and that's the major component of that return, you're not going to get the overall total return that you expect. 2 years are really indicative of that. If you look at what 2 years have done over the course of the last month or so, they were way, way low following the bond sentiment market until, number one, the jobs report, number two, the Fed speak, number three, what we've seen strength and retailing perspective, economic statistics over the last week and a half, and now that 2-year yield looks more like it's following the Fed. It's not following what the bond market is saying. So that's the risk.
Yeah, to build on that, Deborah, one thing that I've been surprised about is everyone's saying they love cash. Everyone's been saying that the short-term debt looks incredibly attractive, and yet yields keep rising. How do you explain that? I mean, typically when people want more of it, prices go lower and the bond yield goes higher. Why are prices going lower if everyone's getting on the same trade?
Well, I really think it has to do with the Fed. The Fed has, really driven the front end of the curve, and it, prior to maybe a week and a half or so ago, was driving mostly 1 year and under yields with where the Fed was going. But now the 2-year has joined into that because people are realizing that what the Fed has said about going higher but staying there for longer is probably going to dictate market returns in 2023. So you can't bet that the Fed is going to get to a terminal rate, call it 1.25%, whatever you think it's going to be, and then start going back down and be back down at maybe 4.5% by the end of the year. That's just not what the market should be thinking, yet it was at the beginning of the year, and I think that's starting to erase. But that's what's driving yields higher, the Fed itself.
Deborah Cunningham, thank you for joining us on that Federated Hermes. That final point I think is really important. In fact, we heard the same thing from the ECB's Fabio Bonetta of the ECB Executive Board, essentially saying that, yes, we've slowed down, and yes, we're at that moment where we think we're getting sufficiently restrictive, but ultimately we might have to stay around here for a while and figure out what's going to happen next. I keep going back to that note that Neil Kashkari wrote at the start of the year in his blog when he said there's a second phase to this, and the second phase is we get up there quickly and then we wait. And then we wait until we're convinced that we're going back towards 2%.
And there's now a new wrinkle to it, which is it might take them a little bit to get up to that place, right? It's not necessarily going to be 2 50 basis point rate hikes and then pause. It's they're more willing to go 25 basis point increments, but it doesn't mean they're going to raise any less than they would otherwise. And that's the point we're hearing from the ECB, as well as potentially the Federal Reserve.
If you find yourself taking longer and longer to explain your view of the world, it means your position is getting weaker. And I hear a lot of people who are bearish on the economy coming into 2023 spending more and more time needing to explain their position. And that starts with the January data.
That's normal.
The January data, it's retail sales. It's just a bounce back from what happened in December, because December was a fluke and this is a bit of a head fake. They don't believe in the jobs report, right? And claims and job openings don't capture the full picture, Lisa. There's something else going on here. And let's see what happens if we get another month of this data. How long will it take for that view to break down? Where you get to the point where you find yourself spending so long trying to explain your position that ultimately you can't even do it anymore.
But this is my question. How much does just the price action define the narrative? And how do you avoid that trap at a time when there's such little clarity?
Well, I don't think you can define the narrative by the price action right now.
Yes.
To your point, if you looked at bonds and looked at the economic data, I think that all makes sense to a lot of people. You look at where the leadership has come from with equities, I can't find the narrative that explains the leadership in equities together with what's happened with the data and what's happening in the bond market. That's tremendously difficult to do.
And I don't know if you can. And one thing that Peter Scheer said was that bonds are setting a much clearer signal at this point than stocks because of some of the, machinations in the derivative space that we were talking about, that perhaps it's just not very clear. At the same time, there is undeniable strength in the economy, and you have to factor that in a real sense.
I like Kettner's note this morning. You guys read it earlier and vamped off it. I just was reading it here, and I love at the bottom of his short note, John, where he says there are green shoots in earnings, and that is corporations adapting. And I'm going to go back, I sound like Michael Dart at 101, to nominal GDP creates an interior animal spirit. The great Phil Correa, dead at 103, I think, expert on solar eclipses of Pioneer, used to say inflation and nominal GDP are bright lights that allow people to do better, to be malleable. You mentioned Hermes out, is it tomorrow?
Yeah.
Yeah, out tomorrow, along with LVMH this week as well. Granted, that's a little niche Dana Telsey area, but corporations are adapting.
Luxury and airlines performing so well. There's a massive China factor in all of that as well.
Yes.
We'll talk about those earnings tomorrow morning. Coming up, there's been a lot of people who thought maybe we'd get a pause in March from the Fed. Steve Englander was one, and he's made a change. We're going to catch up with Steve from Standard Chartered next. From New York City with futures down 0.25%. This is Bloomberg.
Up to date with news from around the world. With the first word, I'm Lisa Mateo. China is questioning whether the U.S. is generally looking to repair ties damaged by the dispute over a balloon. The foreign ministry called on Washington to handle what it calls an unexpected, isolated incident. Later this week, the nation's top diplomats could meet at a security conference in Germany. Some new insight for investors on when the federal government will be at risk of a payments default. Congressional Budget Office estimates it could happen as soon as July if lawmakers fail to raise a debt limit. House Republicans want to hold off on lifting the debt ceiling until Democrats agree to spending cuts. Air India could almost double what already stands to be the biggest aircraft order in commercial aviation history. The carrier has ordered a record 470 planes from Airbus and Boeing. Air India now says it has options to buy another 370 jets. UK consumers are suffering from a cost of living squeeze, caused partly by soaring energy bills. Dale Vince, founder of renewable power supplier Ecotricity, discussed how the government can help ease the crisis.
During this crisis, our government have spent £100 billion subsidising energy bills just to take away some of that pain. That's dealing with the effect, not the cause of the problem. For the same sum of money, we could build all of the infrastructure we need to be 100% green on the grid in electricity and in gas, and that would be a proper investment for our country.
That was Dale Vince, who plans to sell Ecotricity. Earlier, we mistakenly said what he intends to do with the proceeds should the sale occur, and we regret that error. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We've had three head fakes, right? We've had employment in January much stronger than most people surmised. We then had inflation come down less than people surmised. Now we have a boost to retail spending in January that's greater than people surmised. We don't think that the weakness in the dollar is over, in part because we see a more deeper recession coming in the U.S. and North America generally than we do in the rest of the world.
That was Terry Wiseman of Macquarie. Great to catch up with him yesterday, building on the story of the moment, which is strong economic data pushing the Fed to keep on lifting rates. Steve Englander of Standard Chartered dropping his call for a pause in March and saying the following: the Fed is likely to pause when there is a clear sign of labour market slowing. We now expect 25 basis point hikes in March and May, when they were looking for no hikes at all previously and looking for a peak rate, Tom, at the Federal Reserve of 5.25.
Some of the adjustments here that we see, and with us in the studio now, we're going to get right to it. This conversation is so important, particularly after talking to Kenneth Rogoff here a few days ago. Stephen Englander joins us, global head of G10 FX research at Standard Chartered. Do you remember back when you had your one-volume Mundell under your arm at Yale? I mean, did you read international economics cover to cover?
I did, but I think the textbook I used was even older.
Okay. Yeah. Do those textbooks work right now in your analysis out of a pandemic with this unique inflation, unique international dynamics? Do the models, do the theories, do the textbooks work?
I think the basics are still very much in use. I think that the question of sort of how far ahead are consumers and businesses thinking is something that's been introduced since then. But you can understand 95% of what's said with the textbooks I used.
Ken Rogoff here 2 days ago talked about a 6% yield and that we're not framed out for moving of the 5-ish up a little bit higher, not to a Bullard. Bullard speaks today, right? 7% yield, but a 6% yield. What are the ramifications for our listeners and viewers if we enjoy a 5.89% 6-month T-bill?
Yeah, it depends on what's driving it. If it turns out that it's just that the U.S. economy is more resilient, but disinflation continues, which has been kind of what we've seen, it's a strong U.S. exceptionalism story. It means we can exist with higher real interest rates and the economy trucks on, makes U.S. assets very attractive. If it's inflation, it's like colossally risk off. It's still dollar positive in that world, but you kind of know that there's going to be a crash at the end and rates are going to come down.
In this really uncertain moment, with everybody just basically shrugging and not knowing, what's your compass?
You just have to look at the data, and I think that's why the January data were so tough. I mean, retail sales were very strong, but not seasonally adjusted. They dropped 20% every year. The seasonal unemployment in January is 3 million. So you're waiting to see if those numbers are actually confirmed, apart from other issues that may exist with them. But I like looking at continuing claims. I think that's going to be sort of the indicator that ends up being the most reliable.
And we get continuing claims here in less than an hour, but at this point, we've seen them confirm the story that we've seen in JOLTS and also from the jobs data that we saw in January. So right now, what are the chances of the Fed going significantly further than the market is currently expecting?
Well, can I say yours on JOLTS? I mean, it's a sample of 20,000 firms and 30% respond. So, it's a very thin needle that we're standing on. The other part, I think if you actually look at the numbers, 2 month, 4 month, 6 month moving average, the services, ex housing is still continuing to go down. All the big core indicators were headed downwards. I mean, the disinflation story was not destroyed by the CPI. It was actually reaffirmed, but it was the Fed hawkishness that's kind of standing out in the market right now.
Andrew Hollenhorst over at Citigroup just put out a note where he basically said that the surprise has been resilient activity, which means that a recession is less likely, but it raises the probability of a more prolonged period of too high inflation. And they said now that the scenario of the Fed leaving Fed funds rates above the 5.25 to 5.50 rate, which is basically their base case, is growing, or they're going to have to go beyond that. Do you kind of agree, basically, because of some of the inflationary aspects, goods inflation reaccelerating in the car space, does that feed into a view that looks more probable to you as well?
Well, that's kind of our 2024 view. I think if the Fed takes interest rates up, Fed funds up to a 5 handle, the first cut or two doesn't bother them because they still know they're going to be tight. It's, when the market says we're going to have a 3 handle in 2024, if you're not sure that inflation is actually getting close to target, it may be 2024 where the Fed disappoints. Is going from say they hit 5.25 and they go to 5 or 4.75. That's still pretty contractionary. Going to 3.75, they'd better be convinced that it's going to work.
I got to get Standard Chartered on you with the great international reality of your bank day to day. We're going to have Damien Sassower join us in the next hour, and to get out front on that. Thunderstruck at the deterioration I see in Argentina, 99% inflation in Buenos Aires. I got peso, black market nearing 400 peso per dollar. Help us with the immediacy for the International Monetary Fund. John is eagerly awaiting the spring meetings of the IMF. Can they even get there? Or does it look like bailouts for the IMF in March?
Well, I think the higher that rates go, the more pressure there are on the weaker credits, and the more the IMF is going to have to do a lot of running very quickly in order to make sure that the sorts of default scenarios that people are speculating on don't happen. It's a function of rates. I mean, we came in this year, risk premia were falling. Now they're rising. I mean, and I think there's some discussions between the IMF and other central banks and the Fed saying, we love you guys, but look at what you're doing to us.
Is Jerome Powell, as of, 6-month T-bill, 5%? Does that make him central banker to the world, to Nigeria, to Argentina, to the rest so troubled?
Look, the U.S. is 20% of world GDP and 150% of world financial market conditions because it gets exacerbated outside the U.S. So, he's more than central banker to the world. He's like king central banker to the world.
And to be fair, though, the Federal Reserve started hiking a long time after the EM central banks started hiking, didn't they? How are those front loaders doing? Those that went early, went hard, went first?
Well, they did it because some of them could afford to do it. You look at Mexico, you look at Brazil, they have a rate cushion that's looking good. If you started off weak and you couldn't keep up, now, you're facing the possibility that you're in real trouble.
If you had an ideal scenario where the Fed did set policy for the rest of the world, what would they be doing right now?
Probably kind of capping it. But again, they don't. I mean, and that's
no, of course
not.
I'm trying to work out. I mean, we're sitting here saying, the Fed's causing problems, but ultimately I'm looking around the world and they've all got inflation problems, haven't they?
Yeah, well, look, there's some of the inflation problems come because of domestic fiscal policy, because of domestic structural policies that they haven't addressed. It's not all on the Fed, but it looks like it because the Fed is the most dramatic thing that's happening over the last month.
That's the important point. I mean, before you go, Steve, I just wanted to wrap it up. It just feels like a really confusing time for a lot of people. Do you feel the same way? When I hear a Fed speaker or a Fed official, so to speak, and we caught up with one earlier this week, say things like we're data dependent, that just seems like the short way of saying I've got no idea. Is that where we are?
Well, to give them credit, I think they've raised enough that they're not sure where they are. But I think there's a possibility we're in 1981. There's a possibility we're in 1996. There's a whole range of possibilities that are out there with very different implications. And I'd say the probabilities that you would attach to them are not that different. So you have to wait and see how things play out.
It's perhaps unfair to say this, but I wonder if they're almost hoping not to get a repeat of the January payrolls report. Do you sense the same?
I think they light candles every day hoping that they don't get a repeat.
That's the problem. It's it's real. There is this story, and, I like the way you danced around Lisa's question. Lisa's very good question about job openings. It's like you question the actual data. It's no good. Push that over there. With payrolls, I think people are struggling to do that. You get a repeat of it in February, Lisa.
The payrolls response rate has dropped from 60% to less than 45%.
So we're going to do that with payrolls as well?
Well, no, but it's a real problem. You got to. The numbers have to be good.
I'm not saying it's not, but I go back to what I said earlier. It just seems to me that people are spending a lot more time explaining their position from the start of the year. And if you're spending more time explaining it, the position itself must be getting weaker, because if your argument is strong, it should be an easy story to tell.
To your point, the fact that San Francisco Fed put out an entire report about how weather affects employment numbers and how it was an incredible skew based on weather gives you a sense, right? And basically people are saying, oh, well, consumer spending's well because it's nice out, let's go shopping. I mean, it's basically, Sam Rowe put that out yesterday. I thought that was hilarious.
Look, to Steve's point, these are real issues. I'm not here to say they're not real issues. I just think that the January hard data has got everyone just sitting there thinking, I've got no idea really what's going on here. And I guess we're going to find out if we get a repeat in February. Too early to draw conclusions. Seen that line a few times over the last 24 hours. I'm getting a hard time on Twitter. Have you seen this?
Yes, I
About the soup Nazi thing at Seinfeld?
Yeah.
I'm getting a hard time and I deserve a hard time. Ferro doesn't know the Seinfeld soup Nazi, but then gets high-handed about Fire Festival week. I mean, that was deserved. That was deserved. I'm sorry, Tom. I'm sorry.
Thank you for that apology.
Steve, thank you, buddy. It's good to see you, mate.
Steven,
wonderful as always. Just brilliant.
Thank you.
Steve Englander of Standard Chartered. Futures negative 0.25%. Live from New York City. This is Bloomberg.
The market had gotten too far ahead of itself in pricing Fed rate cuts and not keeping up with where the Fed was.
It's still inflation, front and center.
We have seen disinflationary pressures begin to mount.
The economy is flying. What I will say is it's possible that this recession is delayed.
In the next few months, you're going to start to see the U.S. economy weaken. And it's going to be in the context of a global economy that might actually continue to strengthen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Good news on inflation, sort of really good news on retail. Good news here in 29 minutes on claims. John, 4-week moving average claims. Never did I imagine this statistic. 189,000 jobs. That's a stunning optimism.
It's just amazing, Tom. It's amazing. And let's see if we get another tick higher this week like we did last week, but ultimately still in and around 200K. Put it together with the unemployment data, Tom. Put it together with what we've seen in retail sales yesterday. And the hard data has forced a lot of people to reconsider how far this Fed might go.
The reality of the BTMM screen, 4.8, 4.9, 5%, even occasional prints here. Rogoff of Harvard out to 6%, and Bullard speaks today, who nudged 7%. Bullard's going to look prescient here if this keeps going.
A ton of Fed speak coming up a little bit later, but we have to keep going back to the lead story in the equity market. It's where the leadership is coming from against that backdrop in the United States. To see tech still leading, outperforming against the backdrop of high yields and better economic data, it's pretty phenomenal, fascinating to watch.
What do you think Ives will say?
Dan is going to say I was right. That's what Dan's going to say.
Right.
Last year was tough, but I'm right. Look, the earnings weren't good, Tom, from these tech firms. They weren't that great. They really weren't.
I don't agree. I don't agree. I think their cash flows are stunning. I think their currency adjusted, some of them, was outstanding. Luke Mestra for Apple, single line in the middle of the press release nobody read. Ex foreign exchange, it wasn't all that bad.
But it was expected. Right. So this is the issue, is that they meet expectations.
I think you were correct.
Right. So this is the issue, to John's point, is they met expectations. They didn't exceed expectations. Everyone knows this. The change has been a dissonance right now, because typically those stocks do better when you expect a low rate environment to persist. So is the stock market purely noise right now, to what we were hearing from Peter Scheer with some of the manipulations of certain derivative trades, and bonds sending a clear message that this is going to be a Federal Reserve that hikes more than people expect?
And look for Peter Scheer on Bloomberg Digital, folks. That was just a brilliant, brilliant dissertation, hugely valuable. But to the two of you, what I would suggest is, at the minimum, there's 3 markets. There's a speculation Peter Scheer market. There's 4 tech companies doing better than good, and everybody else, I mean, they're not in this NASDAQ rally. Am I right?
I don't think everyone is. What was it called? Lonely over at Max Kettner over at HSBC. It has been lonely. I've always struggled with the idea that the bond market knows something the equity market doesn't. I've always struggled with that. But this year it feels kind of odd. You can nail the bond market call. You could have said yields are going higher. We're going towards 470 again on a 2-year, and then totally failed on the equity market call.
Yeah, well, part of the problem is that we're seeing the economy do better and act more resiliently in the face of higher rates and tighter monetary policy than anyone could have predicted. And this is really the conundrum, is that, is the relationship breaking down a bit in order to see, okay, higher rates necessarily lower stock prices?
I got a great message moments ago. I said, hey, John, you should quote some predictions from average Joes to prove they know no less than these experts. So here's the quote. We feel there is limited upside after the recent rally, and a correction is likely within the next 3 months. That's from Barry from Wealdstone. Barry, thank you. I'm going to do some more of this.
Can we get him?
It's like one of those talk-in shows, those call-in shows on radio or something. We've got to make that happen. We've got to do more of that.
For the 7B tomorrow.
Thank you, Barry. Let me know if you're free tomorrow, and we'll talk about this market. TK, just wonderful.
Absolutely historical. Let's go to the data. But, John, I'm going to say, I didn't have a chance to say this in the last hour. We're coming out of a pandemic. I stood on Fifth Avenue yesterday. The Bentley was stalled in traffic, and Mrs. Keene couldn't get to me in time.
Real average Joe moment, sure.
I watched Fifth Avenue, New York. It's not the same. It's all tourists. There's no employees. Work from home is in full place. It's not what we grew up with, and we're all living that coast to coast.
It's kind of weird.
Yeah.
It is kind of weird. Equity futures right now down 1/3% on the S&P. As Lisa mentioned a few times this morning, we're 25 minutes away from jobless claims data in America. That jobless claims data has been phenomenally low. In the last couple of weeks, though, just last week, we did get a little tick higher. So look out for that. I don't think it's significant just yet, but if we get a trend, it's a trend. 200K on jobless claims is the estimate. 196, Tom, was the previous read on that number.
Right now, this is just perfectly timed. Daniel Morris, we visited with him in London on our last trip, Chief Market Strategist. We're scheduling something in London here coming up. Chief Market Strategist, BNP Paribas in London. Dan, I don't want to talk use of cash, share buybacks, dividend growth, and all that. I want to talk about what our viewers and listeners should do with their use of cash in their portfolio. What do you do with cash right now?
Well, I guess one big change compared to last year is you can look at fixed income as, I think, a much more attractive investment. We've had this massive repricing. Now, of course, we're talking about is Fed funds going to go up another 25 basis points, another perhaps even 50 basis points, perhaps. But we've already had the massive moves last year. So at this point, you're getting a decent coupon. And so I think that's an alternative that we haven't had. Whereas on the equity side, what we're talking about are the risks, still the likelihood that you have a recession in the U.S. this year. That's not going to be good for equities. So that balance of risk reward, I think, is certainly favoring fixed income.
Dan, last year, everyone was a bond trader. They were a bond strategist. You had equity people coming on programs like this saying, look at the bond market. This is going to happen. This is why I don't like stocks. Dan, this year, they're looking at the bond market for signal, and it's not helping them. They're calling for high yields. They're getting them. And then at the same time, tech is outperforming. Dan, we've asked this question for weeks now. Why is tech outperforming as yields climb?
I think two things. So one, we'll have to see how long it persists. I mean, admittedly, it's already gone for several weeks. We've got to see if it can really keep the legs that it's had so far. I mean, there are some headwinds. But nonetheless, if you do go back to the recession call, which is also what we have, you do traditionally see growth outperform value. So at least on a relative basis, that actually is perfectly in line with what you've seen historically and what we would anticipate this year. So it gets us back to what happens with inflation, what does the Fed do, and how does growth respond? But over a slightly longer term view for the year, you do anticipate growth outperforming.
So does this basically mean that if you look past the recent hysteria, we're still in a clearly disinflationary phase and people are getting over their skis when it comes to expected rate hikes?
Well, I won't go quite that far. I think we're, in retrospect, and easier to say always, but I think the big head fake, if you will, that we had with inflation expectations. I mean, at one point, the market was pricing the inflation rate at the end of the year at 2%, which was just a massive fall. But that was based on the data that we thought that we had, except subsequently the data was revised and what you thought was this big disinflationary trend went away. So I think that's another factor in how challenging these markets have been is you come up with a narrative that aligns with the data, but then the data changes.
So what do you do? I mean, basically, how are you positioning where it might be advantageous to be nimble, but also you're seeing pretty incredible rallies in the equity space and the risk space?
I think our response is to still be a bit cautious. We're overall neutral in our portfolios because you're right, you do see these big rallies, but you also see big reversals. So having conviction in a rally that is not only going to be big, but is going to be sustained, I think is really difficult right now. And we think the prudent thing to do is just to wait a bit longer. Let's get some confirmation of the trend from a few more data points that hopefully align in one direction, and then get on that train.
Dan, what would make you change your mind then? You said a few more data points. What would you be looking for?
Well, I think we either need to get confirmation. It comes down to inflation. Do we get back to this inflationary trend, or do we see a plateau? Because I think the risk that we're starting to price in again, the way we did, frankly, at the end of last year, is that Fed funds goes to 5.5 or to 6. And if we do see a plateau in inflation, particularly around wages, that may well be necessary. But again, we've just had 1 month of this surprisingly strong data, payrolls and everything else. It's going to take more than that to convince the market and to convince us.
Hey, Dan, we've got to leave it there. It's great to catch up, as always. Dan Morris there of BNP Paribas Asset Management on this equity market, this bond market, the Fed, Tom, and just why tech is outperforming.
When we do the bank earnings, and Lisa, major shot, I think he just killed the earnings season here with a cross-section away from what most of financial media does. I want to go back to Scott Galloway's great book, The Four. It was my book of the summer years ago, just magnificent must-read book for every student. The Galloway Four is modeled for $310 billion of free cash flow a year from now. I went out and looked at 4 Midwest war horses, Boeing, Deere, Cat, and a troubled 3M, and they're modeled out at $27 billion. 310 versus 27 is why everybody's focused on those 4 stocks, including Dan Ives.
I'm not saying they're not cash machines. They're cash machines. But, Tom, you've got to work out what multiple to put on some of these names.
Oh, yeah.
If growth is decelerating. And some of these companies are telling you that growth is decelerating. They're telling you that the good times of accelerating growth in cloud are coming to an end. They're now talking almost exclusively about AI to try and bid up their stock. We've seen that across some big names.
Exactly, and you already have really high valuations. And let's go to what Jim Bianco is saying. Yes, there are all these other companies that are doing incredible things aside from these 8 names, but those 8 names account for 60% of the total gains on the S&P 500 year to date.
And what's important there, to your point, John, is that Apple's got a 26 multiple off the Bloomberg DS screen. AI, by the way, that means Apple innovation.
Is that what it means?
That's what it means.
That's what it means.
That's what I'm getting you ahead of Ives here.
Is that what ChatGPT said?
Yeah. Who?
Nothing.
I can't even criticize you for not knowing. I'm
you
done.
just
I'm getting
humbled?
slaughtered this morning. Slaughtered for not knowing the soup scene in Seinfeld. I'm just getting absolutely hammered. How can you trust this man? Where's he been?
He hasn't seen the soup Nazi. I mean, it is sort of.
Okay, but I don't get Doctor Who. Is it called Doctor Who?
Yeah, Doctor Who. That was a
I have
British
no
thing.
idea.
It just wasn't. It wasn't that big in the UK.
I'm on an airplane.
It just wasn't.
I remember this very clearly. Virgin Air. It's 2 a.m. The guy in front of me, I can't sleep because he's laughing so hard. I look over the fancy business thing, and he's watching this show called Little Britain.
Oh yeah,
and
that's
I
great.
was addicted to it.
Have you seen that?
And I didn't know a third of the. I didn't know a third of the humor.
That's great. That's brilliant.
I
missed that.
I had no idea.
I missed that. Futures right now down 0.4%. Jobless claims about 18 minutes or so away. Up next on the programme, we'll catch up with Dan Ives of Wedbush on these big tech names.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. A warning from the Congressional Budget Office. It says the federal government would be at risk of a payment default as soon as July if Congress fails to raise the debt limit. House Republicans have threatened to hold off on lifting the debt ceiling until Democrats agree to cut future spending. China will impose fines on Lockheed Martin and Raytheon for selling weapons to Taiwan. The fines are worth twice the value of the company's weapons sales contracts with Taiwan over the last 2.5 years. Lockheed Martin and Raytheon are also barred from exports and imports involving China. There's a report that Russia has lost at least half of its tanks since it invaded Ukraine almost a year ago. That comes from the U.S.-based Institute for Strategic Studies. It says Russia is using older equipment as replacements. A hedge fund star at BlackRock is raising $1 billion following his worst ever loss. Alistair Hibbard will reopen the BlackRock Strategic Equity Hedge Fund for more cash starting at the end of March. Hibbard's fund managed $7.6 billion at the end of last year. He lost 12% in 2022. And Fidelity is bucking the trend of financial industry firings. The Boston-based firm wants to fill about 4,000 jobs by mid-year. Fidelity says the new positions will focus on customer service and technology. That follows a year of record hiring that brought Fidelity's headcount to 68,000. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
What are the main problems in the supply chain? Well, it's a bit across the board, some systemic issues with the availability or the lack of availability of electronic components, chips, that is impacting a lot of suppliers. We've had the energy crisis situation impacting suppliers, a lot of difficulties to find skilled workforce around the world in the post-COVID environment.
The Airbus CEO just bringing it home there. The post-COVID environment, we're still in it. We're still in it, and we keep going back to it, Tom. It's year 3 of pandemic economics for so many of these multinational companies.
Yeah, full disclosure, I'm a big fan of him. I think he's just done a spectacular job there in managing the Toulouse message. I'm big on this, John. We're still in the pandemic. We're out of it. It's not as bad medically. You know, there's some huge moments of joy, but everything we're talking about every day is about the damage done and the move on from it.
Still working out the economics of it all. The post-pandemic labour market, what it all means. Is that labour supply, Lisa, going to come back?
Well, you've raised this point that where is the discussion around long COVID, around people who retired early, around people who died during the pandemic, all of these questions around the structural shift from this health crisis. But I'm going back to what Jim Bianco said, which is we're not going back to a 2019 economy. So what is the new post-pandemic normal? It will not look like the pre-pandemic normal that we
Do you know who we miss? Who we really miss?
Yes.
You know, not to put a downer on it, but you know where I'm going. The late great Alan Kruger.
Yeah.
You just know that he would have done some amazing research on what's happening in this labour market.
And to bring Alan Kruger up, this is towards Lyle Brainard. These are people doing applied economics, not theory, but actually what's going on out there. And that's, Card and Kruger clearly would have been there. Just because of time and his huge popularity, people lean forward on Global Wall Street. For the gentleman from Penn State, they threw him out of State College years ago. He asked too many curious questions. Dan Ives joins us now, equity analyst at Wedbush. Dan, I was talking about Scott Galloway and the 4 earlier. Let's call it the Ives 4. The 4 big companies a year from now, Bloomberg models $310 billion of free cash flow. What's the quality and the predictability, the persistency of the big 4's free cash flow?
Oh, I think right now we're looking 80, 90% visibility and more. I think that's the big difference to what even when you go back a few years ago. And that's what you've seen coming out of Cupertino. It's what's happening in Redmond and well as big tech. And I think that's been a big sort of headline during earnings, better than feared. And I think investors has underinvested in tech going into the years I've seen since 2009.
Should Tim Cook fear China?
I think ultimately he embraces China. I mean, look, Cook is able to navigate China as well as any CEO in the world. Understand that's the hearts and lungs of the supply chain, but also that's 20% of demand in terms of iPhones. And I could tell you, even as of this week, iPhone demand looks strong in China and globally. And that's really what I believe continues to move Apple higher.
Dan, last year we talked a lot about the interest rate sensitivity of the tech space. Are you saying that it's less interest rate sensitive now?
Look, I think the New York City cab driver at this point has sort of factored that into the stock, at least going into earlier this year. I think now when you look, investors have sort of gotten used to it. They've factored that in terms of what the Fed's going to do. We're in the 8th, 9th inning. And now it just comes down to valuations relative to the last 5 years based on growth is as good as we've seen. That's why I think right now a lot of these tech names continue to move higher, because what we see with fundamentals, demand holding up, and you have all that baked into the stocks, which is why these stocks have moved up on lowered guidance and what I would say B-plus type of earnings.
You said that people have gotten used to it. It's basically been baked in, and yet there has been a pretty marked shift in the market since the beginning of the year in terms of where the expectation for rates is, how far the Fed will have to go. At what point does it start to change the discussion around the feature in the tech shares that we've seen year to date?
Yeah, look, Lisa, it's a great question. I just think from a tech investor perspective, the CPI, PPI, white knuckle, print days, macro, I feel like a lot of that's in the rear view. I mean, investors understand you could have another 25 bip. Obviously, things can move around from a Fed perspective. But either way, light's at the end of the tunnel. And now we're starting to get to an investor environment where a soft landing or a no landing looks like what we're seeing across tech earnings.
Dan, I want to ask a question that we've gone over many times before, but it always bears review. Anurag Rana at Bloomberg Intelligence has a vision of where the cloud is going. What does the Ives cloud look like 5 or dare I say 10 years out? These big tech juggernauts, do they have degrees of freedom to move larger in revenue, larger in market share, larger in global footprint, I should say?
They do. Look, I think right now, when you think about moving to the cloud, only 45% of workloads move to the cloud. And I think that when I look at the vision, it's really going to be about artificial intelligence and about that data. And that's why you're seeing this Game of Thrones play out between Microsoft, which was top of the race, Google, obviously the debacle last week. But you're going to see Amazon, you're going to see Apple and others dive into the deep end of the pool, because that's going to be an $800 billion market in a minimum that we see over the next 5 to 6 years.
I looked, Dan, I walked by the Apple store yesterday on Fifth Avenue, and I pointed to Mrs. Keene where I stood on the sidewalk with the wonderful Larry Haverty, who taught us all how to do securities analysis on these tech companies. And he and I did a stand-up interview a decade ago, 12 years ago, 13 years ago, over the death of Apple. Is that gloom still out there?
I think it's the same that said Mahomes was never going to win another Super Bowl. I think you just continue to ultimately have an install base that's increasing. They're gaining share in China, and now you have 1.2 billion iPhones worldwide. You had 975 million 18 months ago, and which is why, in my opinion, this is a rock of Gibraltar tech stock. Haters will continue to hate, but I think again it will be a $3 trillion market cap.
So we talked last year a lot about the winners and the losers of the tech space and that there would be bifurcation, and yet it seems like there isn't bifurcation and that story is basically gone out the window. What do you make of that? The fact that Apple's being lumped in again with Meta or Facebook?
Look, I think what you're starting to see is the headcount cuts, and you've seen that with Zuckerberg and what Meta's done. That's really, along with activism, put a bottom on a lot of these stocks in terms of, and now you're going to start to see, I think over the next 6 to 9 months, more of a deviation, at least fundamental, between winners and losers. But the one thing I'd point out is that any of the frothy names that continues to get sold off, you have significant M&A dry powder, both financial and strategic, as well as activists that are going to swirl across the board. Salesforce is a perfect example. You have, so many that hate it. If you go back 45 days ago, and now I think there's a stock that has significant upside because of activism and because of ultimately numbers better than feared.
Are we now comparing Mahomes to Apple? Is that what we're doing now, Dan?
I think for Apple, you got to start to go to Montana level or Brady.
Yeah, Mahomes, Dan Mahomes is a quarterback for Kansas City, in case you didn't.
I was just making a clarification.
Not yet. Mahomes, clear Hall of Famer. But look, in terms of what Cook and Cupertino have done, Tom Brady again.
That's better, Dan. That's better. Mahomes didn't hit in quite the same way. Dan Ives of Wedbush. Dan, thank you. You can't compare Mahomes to Apple. I mean, come on.
Are you basically provoking the people who are getting on your case about the Soup Nazi episode?
Are they
of
Chiefs
Seinfeld?
fans?
They probably are Chiefs fans. They're going to come after you with pitchforks. That's all I
a
can
hard
say.
time today, aren't I? Okay. Mike McKee's going to drop by in about 5 minutes. He's going to talk about jobless claims. Michelle Maher's going to drop by too from MasterCard.
Oh, great.
MasterCard card data is really interesting. If you look at some of the spending data for January, that would give you a decent lead on what's happening with retail sales. But Tom, just to go back to tech, the year-to-date gains are just phenomenal. They're just phenomenal.
You guys, when we're doing this, we're all working in real time, and Lisa makes me smarter right now. Facebook is up 80% since the Ankampora bottom in October. Is that true?
It's shocking.
I would have never guessed that.
But this is my point. It's that you've seen the biggest
80%.
rallies in the least
Zuckerberg
profitable
is terrible.
companies,
They're going
which
out
is
of
really
business.
one of the questions that I have here.
It was the spending. They were spending too much. You got to October.
So they're acting like adults.
They even changed the name, for goodness sake, to something they were wasting money on at the time, and maybe it will turn out not to be a waste of money. But the return of efficiency to that company, Lisa, that's where the effort is now for 23.
Do they change their name back to Facebook?
I've got no idea. Would that help the stock rally?
After that Super Bowl ad for Gorman?
Maybe.
The guy's going, I'm living in the metaverse, and the baby goes, I don't get it.
Jobless claims up next in America from New York. This is Bloomberg Surveillance.
Bloomberg Surveillance, we welcome you here. What a set of data points we have seen. We're going to get further clarity here. We're going to do this with Farmer McKee. He's, on Old McKee had a farm. PPI-IO or whatever. PPI is not CPI, but it matters. And there's also a small matter of housing starts and jobless claims. We'll let Mr. McKee tell you which matters. Michael?
Well, let's get the numbers and then we'll figure it out. They're just coming in now. PPI for final demand a real change from December. For January, the headline number comes in up 0.7%. January revised down to a negative 0.4%. So a 1.1% swing there in PPI for final demand. Take out food and energy, it's still up 0.5%. And on a year-over-year basis, up 6%. Food and energy core up 5.4%. Those are both lower than we had seen in the prior month, but they're still a very high number. Housing starts come in at 1,309,000 annual rate. That's down 4.5%. They were down 1.4% in December. A bit of a surprise. There had been a thought they might go up because weather was better in January. Building permits up 0.1%. Jobless claims. What do you say about jobless claims? 194,000. And last week was revised to 195, only a tick lower. Let's put it this way. The labor market's hanging in there.
Well, everything is hanging in there.
Finally, we got the Philadelphia Fed index takes a dive, negative 24.3 after a negative 8.9 in December. And I can't tell you what that's about, but I can tell you.
Oh, come on. It's about the Eagles.
That is probably true, Tom. The prices paid index for the Philadelphia Fed is 26.5 versus 24.5. So that's gone up a little bit. So,
We'll let you dig through the numbers. Dig through the numbers while we try to figure out what's going on. There is a turn to the market, which actually, Tom, I'm surprised about, because what the clear conclusion here is PPI, the disinflation that people were talking about in the goods sector, isn't as great as people thought. In fact, this disinflation is really mild. It is not coming down nearly as fast as people expected. Let me give you an example. PPI final demand was expected to come in year over year at 5.4%. It came in at 6%. It declined only of 20 basis points. The revision upward dramatically in the prior month. Again, one data point after another, hotter than expected.
Market catching up with Michael McKee. VIX up a stick right now, 19.15. Deterioration, S&P 500, negative 31 basis points. We do get some inversion in the yield curve, the dynamics of the full faith and credit from negative 80 points to negative 82 basis points, a greater inversion with fractional dollar weakness. I'm not getting much love from the actual 2s and 10s, Lisa, but to your point, PPI is a set of data with revision is a higher inflation regime for business.
This, to me, really is the main takeaway, that inflation is still very high relative to where people had expected it to be, and it hasn't been coming down as quickly. The labor market's still strong. Anyone looking for coincidental data is really getting the same clear message. So is this enough, Michael McKee, to say people underestimated the strength, underestimated the resilience, and that disinflation isn't happening nearly as much as people expected a month ago?
Well, it's not happening as fast as people expected. And I think that was the big takeaway from the numbers that we've gotten this week. People thought, given what we saw in November and December, that prices would come down very quickly. They're coming down, but not very quickly. Goods prices, remember the story was that goods prices were going away and services were the issue. 1.2% rise in goods prices in the PPI for final demand during the month of January, and services only up 0.4%. So the opposite of what we were looking for. And I got to mention the PPI for trade services, which is basically, they calculated from the margins of retailers and wholesalers, up only 0.2% after 0.8 the prior month. So what we're seeing is a compression in margins. And there's a story on the Bloomberg today about how in the past that's usually led to layoffs, which is not happening this time.
We got to get to Michelle Meyer with her wonderful view on the consumer. But, Mike, I've got to ask you about the Fed speak today. Professor Rogoff sat in your chair 2 days ago and began to model out 6% yield structure. Bullard, who speaks today, shocked us with a 7% what if out a ways. Are we shifting up now? Are we going from a low 5-ish up to a higher view or guesstimate out?
Well, right now, the consensus seems to be they're going to get to 5.5. Now, that was yesterday before today's numbers come in strong, although that Philly Fed is an outlier. The issue is we still have a lot of data between now and March 22nd. So a lot of opportunities for people in the markets to either price higher or change their minds.
Much more from Michael McKee through the morning. He'll dive into this wide set of data. This is a joy. Michelle Meyer, I was discovered with her expertise on the consumer and housing a number of years ago. She had a sterling career with Global Wall Street and now gives us an information knowledge with her economics that you can only get at MasterCard, with the MasterCard Economics Institute. Chief U.S. consumer expert Michelle Meyer joins us this morning. Michelle, you get the data like no other market economist in the game. What is the state of the American consumer?
Yeah, Tom. So we are absolutely looking at the consumer with a high level of detail. And what we're seeing and what we have been seeing for a while is that the consumer is out there able and willing to spend. And this speaks to the inflation data. It speaks to the labor market data that the consumer still has purchasing power, right? You have a labor market that's still expanding. Income growth is out there, aggregate income growth in particular. There's still some savings buffer and there's still access to expand the balance sheet. So to underestimate U.S. consumer has been, has been a problem.
Without getting into the Vatican secrets, are you seeing massive credit card usage, and how do the higher interest rates of credit cards fold into your optimism on the consumer?
Look, what we're seeing about the consumer is that they are using all of their sources of purchasing power. And the good news is that they still have a lot of purchasing power coming from the labor market, from job creation. So at the moment, you still have a lot of income flowing in, a disposable income, which is supporting that spending in real time. So consumers don't necessarily have to rely as much on other sources. It's not as though the consumer is strained right now. They're doing a really good job being able to navigate what has been, for the last year, some pretty high prices. And that is what fueled the inflationary numbers that we had seen all throughout last year. But yes, the consumer, of course, has utilized savings. The consumer, of course, has increased credit card usage as well. You've seen, from the Federal Reserve G19 data, revolving credit outstanding has been on the rise after the post-pandemic period where consumers paid down their debt.
Michelle, I'm looking right now. We just got a number of data points from the United States government, and the markets are slow to respond, but they are starting to respond a bit more. You're seeing the NASDAQ down now, near session lows, around down 1% ahead of the open. Do you get the sense that people have bought into the disinflation story too much, that we could see even another bout of reinflation that sends CPI even higher?
So to me, a useful way of looking at inflation is to understand the different drivers of inflation. So the good news on the disinflationary storyline is that the supply side has really come back, right? You've seen this repair of supply chains. You've seen the restocking of retailers. So inventory levels are back to normal, and retailers have been able to return to just-in-time inventories, which makes pricing much easier, much more transparent. And during the holiday season, we did see consumers enjoy a lot more promotions and discounts. So on the good side of the equation, I do think there is a disinflationary story. For services, which is going to be more tied, particularly this super core, which takes out housing, it's going to be more tied to the labor market. And there we know there's still some wage pressure. We know there's still a lot more stickiness. So that's just going to take time. So I do think it's really important when you're looking at inflation is to be able to separate the different parts of the inflation narrative based off of those drivers of inflation. So I don't think the disinflationary story is over, but we have to be aware that it's going to take time.
So what's your sense of where the market is wrong? I'm looking right now at two-year break-evens that are close to 2.9%, that in 2 years from now, you're going to get a 3% essentially inflation rate. Is that bang in line with your expectations based on the consumer spending and the consumer spending power that you see in the granular data?
I think over that time frame, that does seem pretty reasonable. Because if you think about the core goods components, prior to the pandemic, those were deflationary components. They were seeing price reductions. And then you had this dramatic increase in the level of prices, which does not seem sustainable. So a mean reversion back to more normal levels or more of a disinflationary tendency for those categories seems right. And the labor market, we know, was not going to be able to continue at this rate forever. And the Fed Fed is committed to cooling down the labor market. So if you believe in the Fed's resolve, which I think we should, and they're communicating that we should, then yes, inflation should ultimately come down. It's just going to take time. This whole cycle is taking time, and that's what we have to remember.
Michelle Meyer, it's been too long. Thank you so much. MasterCard Economics with us this morning. McKee working feverishly here. He's on page 42 of today's economic data. What was on page 27?
Well, Tom, we're looking at here, I went to the Philadelphia Fed because that's the outlier for the day. Everything else suggests some strength. You could make a marginal case for housing starts, but the headline Philadelphia Fed is negative 24.3 after negative 8.9, and we see new orders drop to negative 13.6. Delivery times got longer, negative 13.6. Inventories rise. Number of employees is cut in half. So at this point, whatever's happening in that Philadelphia, New Jersey region doesn't seem to match what's happening in other parts of the country. And it does look like companies are raising prices in order to meet the demand that's out there overall.
Yeah. To your point, New York Fed Services business activity came in less bad than people expected. So it's definitely region by region. Just real quick here. Are people starting to question the data more that you speak with?
No, I don't think they're questioning the data more, but they're questioning the models that underpin it in the sense that this is not what you are expecting to see. In defense of Federal Reserve officials, they've been saying we're going to see a stickier inflation problem here, and we're going to see below trend growth. So they've been 50% right on that.
We'll continue here with Michael McKee. Lots of good information there as well. VIX out of stick, 19.32. SPX deteriorates negative 30 to negative 36 on the Standard & Poor's 500. Two-year yield fractionally higher. Stay with us from New York. This is Bloomberg Surveillance. Good morning.
You up to date with news from around the world with the first word. I'm Lisa Mateo. China is questioning whether the U.S. is genuinely looking to repair ties damaged by the dispute over a balloon. The foreign ministry called on Washington to handle what it calls an unexpected, isolated incident. Later this week, the nation's top diplomats could meet at a security conference in Germany. Some new insight for investors on when the federal government will be at risk for a payments default. The Congressional Budget Office estimates it could happen as soon as July if lawmakers fail to raise the debt limit. House Republicans want to hold off on lifting the debt ceiling until Democrats agree to spending cuts. The FBI reportedly searched files at the University of Delaware, which houses President Biden's Senate papers. According to the Associated Press, the material that agents took does not appear to contain any classified documents. The president's legal team was said to cooperate with the FBI. In New York City, Mayor Eric Adams is reconsidering his requirement that city employees work in the office 5 days a week. The problem is that city jobs are going unfilled as more flexible work can be a bit more appealing. Air India could almost double what already stands to be the biggest aircraft order in commercial aviation history. The carrier has ordered a record 470 planes from Airbus and Boeing. Air India now says it has options to buy another 370 jets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The higher that rates go, the more pressure there are on the weaker credits, and the more the IMF is going to have to do a lot of running very quickly in order to make sure that the sorts of default scenarios that people are speculating on don't happen. I think there's some discussions between the IMF and other central banks and the Fed saying, "We love you guys, but look at what you're doing to us."
Stephen Englander, brilliant there on the IMF. We're going to get to that in a moment here. This is what Bloomberg surveillance is all about. Tape deterioration, negative 43, down a stick on the S&P 500. NASDAQ deteriorates down 1.3%. VIX out nicely, maybe to threaten 20 here in a moment. Here's the agenda for the next 20 minutes for Global Wall Street. Lisa Abramowicz and Tom Keene with Michael McKee on important headlines from the mathematician from Cleveland. And then he's recovered. He was in recovery off Eagles loss. Damian Sassower here on serious issues in the land of IMF. We're going to talk about that in a moment. Mester McKee, go.
Yeah, she is making some news, Loretta Mester, the president of the Cleveland Fed, bringing the 50 word into the conversation, saying that she saw a compelling case on February 1st to raise the Fed funds rate by 50 basis points instead of the 25 that they did. One would assume that she would carry that belief over into the March 22nd numbers, especially considering the PPI we got today. She doesn't think we're going to get back to 2% inflation until 2025, and wages are a primary reason. They're a percentage point to a percentage and a half above a sustainable level. So wages have to come down. She's also suggesting, however, that she sees extreme weakness in the economy ahead, and many of her contacts in her district are preparing for recession. Now, if only that showed up in the numbers. If she were Pat Harker, then that might explain the Philadelphia Fed numbers. But right now, the rest of the country seems to be moving along fairly well. Jobless claims 194.
S&P negative 46 here. Lisa Abramowicz and I are going to have a conversation. We're going to drag McKee into this because of his experience on 1998 and various and Sunday IMF moments. I've been wanting 3 days to speak to Damian Sassower. He is truly expert at EM credit strategy. A Bloomberg article saying now's the time. I looked at Argentina, Buenos Aires inflation, 99%. Black market pesos, 373, according to Bloomberg News. How close are we to where Georgieva of the IMF has to bail out Argentina, Nigeria, and Sassower land?
Well, I think we're in actually a little bit of a better place relative to where we were just, 3-4 months ago. I mean, let's be clear, Tom, recoveries have improved. The IMF has done a pretty good job. I mean, they've kind of dropped their heels with Tunisia a little bit. But, for the most part, they've done a good job at just improving the playing ground. But my goodness, the move we've seen in credit default swaps, so implied default probabilities out along the perimeter for the most distressed economies in emerging markets, I'm talking Ghana, El Salvador, Ecuador, well, maybe not Ecuador and Ghana, but the others, have all come crashing down. I'm talking like 60, 50% declines in default probabilities, because if you imply what the default probability is from the market price for the credit default swap itself, it tells you that it's down pretty considerably. Right now, there are only 6 emerging markets that have a 1-year implied default probability of 10% or more, which is better than where we were, but it's still pretty bad.
I'm sitting here, I'm distracted by the tape, because what we're seeing right now, the deterioration is notable. You're seeing a 1.5% decline in the NASDAQ on the heels of the data, and then the Fed Mester headlines added to that. But then 2-year yields also surging to new 2023 highs at 4.7%, nearly 4.67%. How much has the entire EM trade and the willingness to extend money to a lot of these developing nations really entirely been predicated on the risk-on rally that we've seen so far this year?
Well, we got to take a step back. We have to talk about which EM asset class we're talking about, because EM sovereign credit, I'm talking emerging markets who have to fund in dollars. I mean, we've seen tons of demand. Investors have been adding to longs there for the better part of the last 3 months. In EM local debt, we're only just starting to scratch the surface of foreigners going back into those markets, places like Mexico, Indonesia. You're actually seeing the buying stalling right now on the news of this no landing scenario and what Mester and everybody's saying. But then if you look at EM currencies, that was a huge short covering rally, right? And that's kind of done now.
It's the short covering is done, and then the now what is important. Let's go to Michael McKee on this. You and I read Stanley Fischer, that little red book that came out after 1998, cover to cover. I mean, we've been here before. What's different this time about the IMF versus other moments of rising rates folding into fiscal realities for nations?
Well, obviously they have gotten better at surveillance, so to speak.
Nailed that.
Little plug there. in keeping track of what's going on in emerging markets and especially their current account balances. And they have urged countries to build up those balances, which they have done, which makes things a little bit better. There's more transparency. There's more information out there, so people can react more quickly. One of the big changes, too, I think, and Damien will know this, is the Washington consensus has sort of gone away.
That
the
went
idea
away.
that what you do is you jack interest rates up when your currency starts to fall. And now there's much more of an individualized view of how to keep these countries' heads above water.
S&P futures deteriorate -47. And Lisa, there's the Bloomberg headline on the 10-year yield, highest since the beginning of the year, 3.84%.
You've seen a similar move in the 2-year yield. You've seen dollar strength, euro weakness, 106.77. Basically a percolating risk-off feel as people realize that the data highlights a persistency to the inflation that really calls into question how quick this disinflationary process will be. And Damien, I do wonder, we've talked a lot about the effect of China's reopening. We've talked about it with respect to the developing world. How much is that part of what's underpinning this, that there has been greater demand and less of a deterioration than we otherwise would have gotten?
Lisa, you have taken me right to where I want to go this time. I mean, the correlation between emerging market credit default swaps and China CDS is as high as I've seen it in years. And I mean, I'm talking 91% correlated between China 5-year CDS and EM CDX. I'm talking there are 6, maybe even 7 or 8 individual countries whose correlations to China CDS are now 80, 90% plus. Wow. So that means China is driving the entire complex. Sorry about that. And then the other thing I'd probably say about it is what is the more durable story here looking out over multiple quarters? Is it going to be the inflation story? I don't think so, because we really don't know with natural gas and energy prices. I think it's a growth story. I think it's a China reopening story. I think that has greater durability for foreign exchange managers. And so from my perspective, I think you probably want to play those themes. I'm talking Aussie dollar. I'm talking the Andean region. So you're saying
this is an EM opportunity, given the rate regime of Mr. Powell and the rest?
It's always an opportunity in emerging markets. It's all in the eye of the beholder. Do you want to fund in dollars? Do you want to fund in yen? I personally think you probably do want to fund in the low yielders. I think the carry trade is back on in emerging markets.
When do I buy 4,000 square feet in Buenos Aires? I mean, the wealth devaluation in these nations is shocking.
It's shocking. I mean, but the wealth, I'll tell you where the wealth devaluation isn't. It's in Bermuda. I was in Bermuda just last week, meeting with clients there, talking to the reinsurance capital of the world and those who allocate money out and run,
What'd you learn quick?
I'll tell you really quick what I learned. They have a lot of exposure to U.S. housing and U.S. banks. A lot of exposure. So let's,
Lisa,
let's be careful.
Before we really close out, as we head into the market opening, the U.S. Markets, I'm curious, as you parse through the data, Mike, is the takeaway different than the initial read? Because it seems like this market is responding more aggressively now.
I think it's exactly the initial read. People are looking at these numbers for producer prices and folding them in to the CPI that we got and folding them into the economic strength that we got and thinking, well, the Fed is going to have to go higher for longer. And then you have Loretta Mester backing it up saying, well, we could have done 50 the last time.
1-2 punch.
So maybe we're going to do it again.
Okay.
The interesting thing is the Fed has said all along we're going to need to go over 5% and do more. This is just kind of the market catching up to what Fed officials thought.
Okay, can we do this again, guys? Are you on speaking terms? I don't even know.
No one responded.
Damien Sasso or Michael McKee, you and me, Damien Sasso and Michael McKee, thank you so much, folks. This is what it's about, the intellectual firepower here. Totally. On fire. Futures at -45. They deteriorate from about -32 down a stick. NASDAQ down 1.4%. And John, I sound like John Farrell. What's that about? Dow futures -272. And the VIX getting out near a 20 level. We have a reinversion. Let me explain this quickly. It's what the adults look at. -90 beeps. We had less inversion, less angst to -80, and we come halfway back now to -84 basis points. So that's the at least I guess whipsaw is sort of like the word of this FOMO Thursday.
Yeah, it's been a whipsaw, but today it seems like it's less of a whipsaw. It was more conclusive as people parse through this data. There is this issue that Mike McKee brought up, which is fascinating, that this is what the Fed's been saying. this is their own projections, and this is the market catching up as the data reveals a reality that perhaps was a bit different than what people were expecting.
Please stay with us on Bloomberg Radio and Bloomberg Television through the day. The Chief Executive Officer of Generous Motors, Mary Barra, will be with us. I believe that's in the 3 p.m. hour in New York. Yes, 3 p.m. In New York. And we're going to get right to the markets on a move now off of really, really interesting data. I would accentuate business inflation, a little more inflatey. Thanks so much for watching. This is Bloomberg Surveillance.